Good morning, everyone. We are pleased to welcome you to today's session on the Conference on Small Business Development and Growth. So let's start with the first session directly. We will be tight on schedule. So the first session will feature 3 papers. The first paper is on International Reserve Management and Firm Investment in Emerging Markets Economies by Joshua Eisenman. The second paper is on short-term finance, long-term effects, theory and evidence from Morocco, presented by Min Fang. And the third paper is on microequity and mutuality, experimental evidence on credit with performance, contingent repayment, presented by Mohamed Meki. So without delay, I invite Mr. Joshua Eisenman for the presentation.
Good morning. So this is a joint paper with Chuang and Qian, and I'll start by introducing the big picture. Then I'll summarize the abstract, and then I'll try to put it in the context of global issues. And I'll run through maybe 5 estimated equations, and I'll conclude. So to put it in the context of yesterday's presentation, we are exposed to several very interesting controlled experiments showing us the capacity to deliver some interesting controlled experiments. So what you will see here is something that, to my knowledge, short of maybe powerful countries like China and having powerful treasury and central bank, practically it's very hard to think about controlled experiments. One can implement some versions of it, so don't expect the results here to be of any sharpness of the type that you have seen yesterday. It implies also that some of the claims of causality should be taken with a grain of salt, because it's macro. So causality in macro is in the eye of the beholder. So at best, you'll see claims that the results are consistent with some priors and some theory. But we will play the game of macro, and you should be aware that there is sometimes friction between those that hate macro regressions. But we are dealing with critical issues at a global level, so there is no escape, but one should look at this more carefully. So let me point out that this is a joint paper with Chuang and Qian. I met them 20 years ago when we shared the University of California at Santa Cruz, and we share the passion of dealing with what one may refer as the extended Mondel's trilemma, which is dealing really with the modern incarnation of the trade-offs between interest rate policy of the central bank, financial integration, and other factors. And on the top of this, the last 20 years, because of massive volatility, the central bank is facing also the charter of trying to deal with containing volatility. So this is the big picture. And let me point out that we studied the effect of international reserve managements conducted by central banks in emerging markets. And the focus here is on the impact of exchange rate management on the firm-level investment in the presence of global financial shocks. So here we are using firm-level data from 46 emerging markets from 2000 to 2018. Now, the focus is important because if you're looking at the last 30 years, most of the global growth was explained by emerging markets. But there's a huge variation in the ability of emerging markets to push investments. So the hope is to come with some recommendations that are explaining to what degree active exchange rate management is useful. Now, part of the issue of macro, unlike controlled experiments, is that you'll see that the key variables that we are looking for frequently are not public information. So central banks don't have the incentive to reveal fully plenty of interesting information that for doing research we need to know. So active management of exchange rate, ideally you would like to know what is the patterns of the portfolio, including the currency composition of reserves, and what exactly the central bank is doing. And rarely you have this information. And this is an issue that everybody is grappling in various ways, and you'll see that we are trying to replicate whatever that you can do. On the top of this, the latest trend is that the story is much more complex than management of reserves, because the trend of the last 15 years has been massive reshuffling from reserves to sovereign wealth funds. And sovereign wealth funds are totally opaque in the sense that we don't have even the credible information about what's going on there. So there are plenty of data issues, and we will do the best subject to the data that we have. So let me summarize the main results. Active international reserve is associated with higher firm investment. The effect strengthened with the magnitude of adverse external financial shocks. Financially constrained firms, compared to unconstrained, are less responsive to active international reserve management. We quantified the effect of active international reserve management on firm investment and find that about 30% of it seem to be going through impacting the country sovereign spread. At this stage, we are unable to say anything about the remaining. Capital controls and exchange rate management complement the international reserve management in terms of achieving this type of goals. So it's beneficial from the macro management perspective to include international reserve management to safeguard the firm against global financial shocks. So then we close running what is called Granger causality, and using VAR country-level data affirms the significance of Granger causal effect in the context of today exchange rate management with a lag has significant effects within 2 years. So the background is, I think, quite well appreciated now, that sudden spikes of global financial risk, frequently we focus on, on measures like VAR and the like, and other related measures that you'll see. The outcome is credit supply crunches, widen credit spreads, inducing drop in investment, and occasionally sudden stops, and de facto it implies also a capital flight crisis and occasionally banking crisis. So in order to minimize the risk of capital flight crisis, emerging market central banks may implement active management of exchange rate strategy, and this is akin to leaning against the wind policy. And in a nutshell, ideally, accumulate international reserves in good times and sell them in challenging or crisis periods to provide you a buffer against financial instability if you are doing it right. So this may reduce, under certain conditions, the financial spreads and the credit rating of the improving credit rating of the country. In the past, I looked more carefully in several episodes on whatever that Russia has accomplished in the past 10 years, and Russia is a great example of a country that invested a lot in management. I don't have the time to talk about this, but definitely, if you're looking for case studies, we have by now, unfortunately, or luckily, depending on your perspective, Russia is a prime example of some of the beneficial effects of this type of policies. So the big picture is that here you can see a summary of really 30 years of massive changes in reserves. So it starts with the period from, if you wish, 1990s to 2000. And is there a pointer here? Okay. So what you see here is that from 1990 to 2000, there was a mild increase in reserve to GDP. Asia is dominating because the saving rate in Asia is much higher, but the trend is similar, and the story here is that at the beginning of 1980s, there was the exit from the lost decade of growth of emerging markets, and in this context, to the surprise of some of us, more emerging markets open up their financial system, and the outcome is that they decided to accumulate reserves as a potential buffer dealing with the coming exposure. Then we have the wave of crisis that goes back to the first domino, if you are counting, was the tequila crisis in Mexico, then there was the East Asian crisis, and then the Brazilian and the like. So by 2000, everybody understood that if you don't want to shut the process of financial integration, so then it's better the case that you'll accumulate plenty of reserves. So what you see here is that practically from 2000, there was a huge increase in accumulation of reserves. Reserves used to be, before, if you are going back 40 years ago, about 3 months of, or half a year of supporting exports and imports. Not anymore. It reached, for Asia, about 20%. In China, at the peak, it reached much higher rates. Now, from 2012, notice that there is a decline. Now, there are two interpretations of the decline. The first is that from 2012, we have a sequence of crises, and then in bad times, you decumulate reserves as part of the management. But this is only half of the story. The second story is that central banks that accumulated huge pile of reserves, including China, noted that they are wasting plenty of opportunities because the real return for China on its reserves is totally negative if you are internalizing the patterns of growth of China. So a fair share of this was reallocation of reserves into sovereign wealth fund, and then there is an interesting distribution of what one can accomplish, but we don't have enough data to include the role of management of a sovereign wealth fund, but I think that this is one of the limitations, and plenty of very interesting things are happening that are really, you can find anecdotal evidence. Sometimes it's more than this, but you need really forensic evidence in order to understand what's going on. So let me move into the methodology. We apply a Q investment framework and use annual data for roughly 20,000 publicly listed firm in 46 emerging markets. The window is relatively short, 2000 to 2018, so we don't have the COVID, but if you recall, this is a window that started with the elusive Great Moderation that was destroyed by the financial crisis, and then by the Euro crisis, and then when we started the exit, in 2019, we have another crisis, so maybe 5 years from now, we'll update this with all the bad events that will keep happening. Now, because of the absence of official data, we constructed 5 alternative measures of international reserve management. So this is the key variable, but we really don't have full information about what's going on. And there is variation in the willingness of countries to open the books of the central bank, and sometimes it's related also to the treasury and then interaction between the two. So a good benchmark paper is by Dominguez and, oops, I'm moving in the wrong direction. Dominguez with 2 co-authors, and we are following her methodology. If you have not seen the paper, if you're interested, it's a very important contribution because this is a good benchmark. Then we are adding to this benchmark other developments. And the main issue is that you would like to control for valuation effect that are the outcome of changes in the relative prices without active management. And you'd like to control for other changes that are not the outcome of active policy. So we'd like to identify active policy. So maybe to show you what's going on, this is from that paper, which is the first one that provided, I think, a solid way of trying to filter out the passive part. And here are 2 countries, Colombia and Mexico. So they focus on the trending also because if there is an active attempt to accumulate or decumulate related to a trend, so this is really on average not an active policy. So what you see here is that the the chart at the bottom, negative is active selling of reserves, positive is buying reserves. Now, this is only one way, and in the paper you have full details on the 5 ways that we are trying to track different ways of active management of reserves, which is the key variable. And again, none of them is perfect, but the good news is all of them are collinear and highly correlated, such that in the sensitivity analysis, the results are overall robust to the precise measure that we are using. Let me skip the details because they are tedious and I don't have the time. Let me point out that plenty of scholars are working on this direction, in this direction. Romain and Kotos did important research, but maybe by now it's a field that has maybe 40 very interesting contributions. So all of this is in the paper. You can download it via the NBR. If you have a problem, email to me and I'll send you. I'm not mentioning all this history, but let me turn to the big story. So the first approach, oops, I'm skipping too fast. So to assess the implication of this story, yeah. So the conventional wisdom now is looking at changes in VIX as a proxy for global financial shocks. Now, the VIX is totally self-centered on the US. By now, there are VIXs that are more sensitive to Europe or whatever is the region that you are playing. So we are aware of this and we are controlling for augmented measures. So in the first round of the regression, we use Euler's regression with several strategies to identify what we are calling potential causal effect of financial reserve management on firm investment. And it includes also instrumental variable and other tricks. And again, if you don't like regressions in macro, at least the good news is that some of the results are consistent with our priors. We find that 1% increase in active international reserve management is associated with extra 2% of firm investment by emerging markets. So then we are looking at a multiplicative regression setup. And the main idea is that there may be a nonlinear interaction between international reserve management and the changes in VIX. So we are confirming this, and then to assess the implications of firm financial conditions, we measure the financial constraints in 3 ways. Access to external financing following the contributions of Rajan and Zingelas, tangible asset coverage, Claessens and Levin, following their methodology, and then the shadow cost of external financing, which is by White and Wu, and this is the outcome of a more full-blown structural equation. So we find that financial constraints weaken firm response to international reserve management, and the average positive effect of international reserve management on firm investment is of the financial constraints is less than a third of the unconstraints. So this is intuitively, I think, quite clear, and this is consistent with the related results that really the financial constraint is binding a lot of firms in emerging markets. And this by itself is limiting the ability of the best reserve management to help them. But nevertheless, there is the margin of helping those that are less facing the constraint. Countries with capital controls compared to those without display a higher effect of international reserve management. And this intuition is also consistent with a wave of literature that include also race contribution, arguing that at the end, capital controls are very important in regaining some ability of monetary authorities to do something. But of course, it's beyond monetary authorities once that you are looking at macroprudential regulations. Now, the combination of flexible exchange rates with capital control substantially enhance the effectiveness of international reserve management. And then it suggests that deeper coordination between all the branches, which may include the central bank, the treasury, and depending on the country, the body that is imposing macroprudentials and the like, is essential for better handling. And then I mentioned country-level VAR reveal positive effect of international reserve management on aggregate investment per GDP by 0.3% in 2 years in response to a 1 standard deviation increase in active international reserve management. And this is in line with the possibility of gradual causal effect of reserve management on firm investment. So let me run fast on this. I mentioned it before that the most important benchmark is Dumigens et al. Then we are doing maybe 3 permutations on this by filtering out trends. And then we are relying on information that sometimes you can collect either from the IMF or other sources of currency compositions, and then you can clean for the if you use valuation effects. So let me skip the details there in the paper. Then we are looking at the sensitivity of the results with respect to these 5 permutations of the active reserve management, and it turned out that overall the results are robust. So then there are ways of going beyond the VIX, changing the VIXs as the source of external shock. So here we are summarizing several of the tricks of the literature. So Chari et al. Extended the VIX into a system which is more sensitive to the fact that VIX is US-centric, and then you can add measurements of volatility which are more tracking the global investable market. And then we are looking also at the possibility of the opposite, looking at the percentage changes of the funds rate of the US as alternative measure of global financial shocks. At least, you know, at the peak of quantitative easing, the claim is that banks, central banks are the only game in town, and then probably the Fed was the only active game in the town, because according to the US-centric interpretation, the ECB really adapted within a lag a lot of the policies of the Fed. But of course, the ECB went well beyond the Fed, so it's useful to augment the information in all these dimensions. So then there is also the US news-based index of monetary policy uncertainty by Becker and al. And it's fair to say that, again, the big story is robust to these type of alterations. So I don't have enough time to go through a methodic summary of the equations, but here you have a flavor, investment on the left-hand side, and then a bunch of controls, international reserve management, and then the changes in the VIX. And then we have index of country firm and near dummies and time invariant fixed effects. But then we would like to go beyond this. So we include also the real GDP as a growth rate, as correlated with investment opportunities, and then also institutional risk assessment of ICRG, including contract viability, profit repatriation, and payment delays and the like. And then we are looking at firm-specific factors affecting investment beyond Tobin skew, cash flow from operations, firm size, sale growth, and the like. So let me move further. We exclude services and other subsectors such that the focus is mostly on manufacturing. Here we have a laundry list of the sectors that we are excluding. We are adjusting the methodology to reduce the share of outliers. And then we find that active reserve management positively increases firm investment. The effect is about 2% in firm investment. And then we are trying to calibrate it to, down the road to a country that is in the, if you wish, mean of the distribution of the countries that we have. It turned out to be the Philippines. So let me move shortly to this summary. So if you are looking at the big picture, we are also adding interaction between the reserve management and global financial shocks, and we confirm that this mathematical effect is important, and it magnifies the results depending on the, of course, the direction, ups or down, and the details are in the paper. So here, focusing on the Philippines, is to give you a sense of the magnitude of a country which is somehow in the median. So for a median size firm in the median GDP country, the Philippines, a $1 billion active reserve accumulation is associated with about 1 million more firm investment in the presence of one standard deviation VIX shock. The Philippines has roughly 220 firms. So this adds up to, in this, if you wish, simulation to about 1 million international reserve management is delivering about 240 million more investment. What we didn't try to do so far is to look at the, if you wish, public finance cost-benefit assessment, is it's worth it? Now, maybe we'll go in that direction, maybe not, so depending on the data that we have. But at least for the Philippines, these results seem to be significant. Now, then we are looking at firm heterogeneity, controlling for it, and then we are adding various controls. And we are also playing around with financial constraint measures in various permutations, and overall the results are overall robust. So the last item I mentioned was the trying to understand a plausible channel, and then looking more carefully, our assessment is that proper management of reserves has significant effect on reducing sovereign spreads, and this by itself, through channels that we, at this stage, don't follow enough because we don't have information, chances are that these alleviate some of the financial constraints, and this explains roughly 30% of the transmission. So I think that I don't have the time to go through these details, but we are extending it in several ways of looking at JP Morgan market bond spreads in order to identify this effect of the channel of country risk, and the results are consistent with our prior. In the process, we are trying to clean the country spread proxy due to issues of simultaneity, and the details are in the paper. So let me maybe summarize the additional analysis. We test alternative measures of international reserve management, alternative measures of global financial shocks, different data sample, and we are looking also on some important case studies like the taper tantrum. And then what we find is the same results, but because the volatility increased substantially, so the magnitude of these results increased too. So once that the volatility is higher, so if you are managing the reserves properly, so the beneficial effect is higher. Then, I mentioned just now, we focused beyond the taper tantrum also on the global financial crisis in the first year. The taper tantrum was the beginning of the end. And then we are also looked at other important events. And the main result is that the higher the volatility, if you're lucky enough that you accumulated enough liquidity before, then you can reap some of the benefits from it. So we are trying to take care of possible sample selection bias by either looking at the largest 50 firms, and then we are trying to control for non-survival firms. And again, the big picture seems to be robust. So I mentioned before that controlling for the vector of capital controls and shared regime suggests that definitely if you are doing it right, you are magnifying the effect, and this is in line with the background literature. So let me maybe conclude. So countries that impose capital controls are found to invest more. And if you recall, 30 years ago, the IMF was unhappy with capital controls, but the trend now is that we added, if you wish, financial stability to the goals of the trilemma, which the fourth leg is financial stability. And there is greater recognition that proper management of capital controls, we politically correct, the IMF is calling this sometimes prudential regulations. If you are doing it right, there are benefits for this. And so this is an important result. Now, the effects of proper management is proportionate to the global volatility. And we believe that we are underestimate these effects because we don't have access to whatever that is happening to sovereign wealth funds. I mentioned before that with a friend, which is at the Asian Development Bank, we looked more carefully at all the information that we had until, I think, 2 years ago about whatever that Russia is doing, and we are convinced that Russia, with the help of the leadership of the past two managers of the central bank, did outstanding job of preparation to whatever that is unfolding now. But of course, we don't have now full information about what is the role of sovereign wealth funds. But for sure, China, Russia, and a fair share of countries relegated maybe third. That's a conservative estimate of the management into a complex reliance on sovereign wealth fund. So at the end, all the measurements here are lacking a full assessment of cost-benefit analysis, but doing it is a major challenge. If you recall, until the onset of the rise in the interest rates, the real interest rate was negative. So chances are that this management was not too expensive at that era, and at least this remains an open question that some studies looked at case studies, and the outcome is that if you are not overdoing it, the cost benefit is positive. China was an exception because they wasted huge sums by dumping it into inferior asset, safe asset with negative real interest rate because of their rapid growth. Not anymore. They are moving or moved aggressively. Time will tell to what degree some of these went through the Belt project. So time will tell to what degree the return on the Belt project will justify it. Okay, so let me point out that this touches a lot of open issues that I think that the present evolution of it's not only what happened in Russia. There are a lot of secondary effects between Russia, Turkey, India, and a fair share of emerging markets that are playing the game of staying in between Russia and China and the EU and the US. So I think that this is an open agenda that the importance has increased considering the latest development and news. So thank you very much.
Thank you very much, Mr. Eisenman, for this paper, which is very relevant to the current economic situation. I will open the floor if there are any questions. Okay, sorry. Let's first start with the discussion. So our discussant is Yannick Galantis from the Banque de France.
Okay, good morning to everybody. And thanks to the organizers for having me here. It's been a great conference so far. So let me start with a quick word on the policy context. So in a way, you could say that it all started with the 1998 Asian crisis, which led to self-insurance, by a lot of emerging countries in the form of accumulating reserves. And this had profound consequences in both the global economy and global policymaking. So it's one of the candidate explanation for the global saving glut and the lack of safe assets, which were very important features of the global economy pre-COVID. And we still don't know if these are going to be features of the global economy after COVID, but we'll see. It led to a long and still ongoing policy discussion on how to set a satisfactory global financial safety net. And policymakers working on these issues have been very, very busy in the past 15 years in international meetings. And it also led, as Joshua said, to a gradual but quite remarkable change in the policy consensus in international institutions. And one example of this is the so-called new institutional view of the IMF on capital flows management. Capital flows management is, in the official lingo, this is the name for capital controls. So an important research agenda is, given the importance of that policy of reserve accumulation, what is the impact on the real economy? And if you want to understand that, really, you want to go all the way down to the firm level. And that's what Joshua and his co-authors are up to in this paper. Okay, so what do they find? They find that firms invest more when the central bank actively accumulates more reserves. And this is robust to a bunch of alternative specifications, measures, samples, so it's really a feature of the data. It's even more so the case during episodes of global risk increases, for example, measured by an increase in the VIX. And the results are driven by countries with a fixed exchange rate or countries with capital controls. And that's also driven by financially unconstrained firms. So I'm going to make 3 comments. The first one is, I'm wondering if capital flows can act as a confounder in the econometrics. So think of it that way. When capital flows in, it could finance domestic investment, so investment goes up. And if you're in a country with a fixed exchange rate, the central bank is going to accumulate reserves to prevent an appreciation of the currency. So the variable, the international reserve management variable is going to go up, and you get a positive co-movement between both variables. You have the same things when capital flows out, but if you have financial constraint, you may think that investment decreases even more when capital flows out than it did increase when capital went in. And so you'd get an even stronger positive co-movement during crisis. So if this is indeed taking place in the data, then you get a possible upward bias in those 2 coefficients, beta 1 and beta 3. Beta 1 is the coefficient of reserve management in the equation, and beta 3 the coefficient in the interaction term. Reserve management interacted with a crisis indicator, the increase in the VIX. So, okay, can we rule this out? So what evidence do we have in the paper about this? Well, first evidence we have is that the results are driven by countries with a fixed exchange rate, which are the countries where this problem might arise. So it's not a proof, but it's certainly a reason to worry. Now, of course, Joshua and his co-authors are fully aware of the issue, and what they do is they purge the measure of reserve management from the net international investment position to try to account for this. But I'm not sure whether this is enough. And here, maybe I'm misunderstanding what you're doing, but I think the net international investment position is a stock variable, and you'd really want to control for a flow variable to rule this out. So one way to do this would be to use a proxy of capital flows, and arguably a good proxy is the country spread. And indeed, there is a regression in the paper where you control for the country spread. And that's this one here on the right-hand side. So on the left-hand side, you get a baseline regression with both terms, the direct effect of reserve management and the interaction terms with in crisis times when the VIX increases. And on the right-hand side, you get the same regressions, but controlling for the country spread. And as you can see, the coefficient on reserve management, beta 1, is about the same in both equations. But the coefficient on the interaction terms is much lower, and it's even negative in the second case. So I would interpret this as the evidence that capital flows can be a confounding factor, at least in crisis time. But the good news is that it's not so much a problem in normal times. Now, in the paper, there's another interpretation for these results, which is the causal mediation effect, which is also a plausible interpretation. But I think really, as Joshua said, there's causality is in the eyes of the beholder. So both interpretations are as likely, I guess. The good news is that this confounding problem doesn't affect normal times, but only crisis times, which leads me to my second comment, ex ante versus ex post central bank interventions. There are really two types of interventions. Ex ante, in tranquil time, you accumulate reserves. This creates a safer environment, and then firms invest more. So in this equation, if this policy is successful, you'd expect a positive beta 1 coefficient, and that's the result of the paper, and it's robust to a bunch of controls. Ex post, in crisis time, so when the VIX increases, now's the time to use your reserves. So you're selling your reserves, so the IRM variable is declining, it's even becoming negative, and you use the reserve to stabilize the domestic financial system to keep the credit flowing to firms. And if this is successful, this should sustain investment, and so you would expect a negative beta 3 coefficient if exposed policies are effective. Okay, what evidence do we have for this in the paper? Well, first there's the VAR evidence using macro data, where you see that indeed, when you have a positive VIX shock, at impact, the response of reserve management is to decrease reserve. So there are exposed policies in the data. Then, as I showed you, when you control for the country spread, you get a negative beta 3 coefficient. So there is some signature of if somehow effective policies exposed, but it's not statistically significant, so it's not completely clear whether they're really, truly effective. So one thing that you might want to try to better disentangle both types of interventions is to look separately at cases of increases in reserves, so the IRM variable is positive, and decreases in reserves, the IRM variable is negative, and both in tranquil times and in crisis times, and that might help you understand a little bit better what is going on here. Now, suppose that you were to find that only ex-ante interventions are effective, then that would lead me to my third comment, which is, are we talking about a precautionary channel, or are we talking about a mercantilist channel? So I mean, this is a usual discussion when you talk about reserves. So what would be the mercantilist channel of reserve accumulation? So suppose you accumulate reserves. If you are in a country with free capital mobility, this shouldn't have an impact on the exchange rate. But if you have capital controls in place, that should depreciate the currency. And then, this might lead to more investment, at least for exporting firms. Okay, so in the paper, one thing we know is that the result is driven by countries with capital controls, which is where you would expect the mercantilist channel to play a role. So again, it's not approved, but at least it's some evidence that is consistent with this prior. Of course, they are aware of it, so they're trying to address this issue. And the way they do it in the paper is they purge the reserve accumulation variable from a purchasing power parity conversion factor. But again, I'm wondering if this is enough, because purchasing power parity is driven by other factors, the level of development, the Bolasa-Samuelson effect, whether you're a commodity exporter or not. So maybe there's more to be done to really try to capture the mercantilist channel. So here are three suggestions. The first one would be to use a measure of currency misalignment. So it's the same idea as the PPP factor, but it's a little bit more refined. There are several measures out there in the literature. Hopefully there's one with a large enough sample that coincides with the sample of the paper that could be used. Another idea would be to use the importance of foreign currency debt, at least at the country level, if the data is not available at the firm level. And the reason is that the precautionary motive really should matter more if you have foreign currency debt, because then you have currency mismatches, and this is where having access to international liquidity in the form of reserves is useful in crisis time. And with the same kind of idea, you could also look at the sectors in which the firms are active. You would expect the mercantilist channel to be stronger for firms in the tradable sector, and the precautionary channel to be stronger in firms in the non-tradable sector, where you have a higher likelihood of currency mismatches. Now, this may be complicated because, depending on which sector you exclude from the econometrics, but maybe, even in the manufacturing sector, there may be sectors that are more export-oriented and others that are less. So maybe you could look at something like this. And that's it for me. Thank you very much.
Thank you very much for the insightful comments. So we will try to adapt all the points that you are making. Let me make some general remarks. Okay, so should I press? Yeah. So we will try to adapt to all the comments. So I have only a few remarks in terms of interpretation. I think that Romain and others showed that a key feature of stabilization accomplished by active management of reserves is making the real exchange rate more stable. So there are plenty of evidence, and also in our paper, that this is part of the idea. Now, the mercantilist channel typically would like not only to stabilize the real exchange rate, but to fight against the appreciation of a successful country like China that is taking out through manufacturing. So at least past research that we played around is that it matters a lot if you are talking about Russia, which is by now really commodity-based country. They killed practically most of the manufacturing, versus China. So I think that you are right that these are different issues. So I think that I'm sympathetic to this, but in the case of Russia, I think that this is not an issue. In the context of capital controls, you can play a role of fighting the real exchange rate with limited capital controls. So this is a race against trends. Now, there's a huge debate about the degree to which this trend continues, so I agree that it will be very interesting to see what's going on. We know that de facto, I think that with the global chain that is not operating well, so it will be quite hard to double check precisely what's going on, because at this stage, the global production chain changed everything from the time that China, if you are going back through the decade of the fastest growth, the role of the global supply chain was quite limited, say from 1995 until 2005, which was the peak of the Chinese decade. So I think that you are right that it's an important issue, but then we should be aware that with the global chain of production, things are much more complex relative to the benchmark of the literature that at the peak was around say 2000 to 2010. Otherwise, I fully agree with all the points. Thank you.
Okay, so now it's time for a few questions.
It's a small question. You analyzed the relation between investment and international reserve management. We take into consideration period of financial stress, and you also give some results where you differentiate between constrained firms and non-constrained firms. I would like to know if you have some results related to exporting firms and non-exporting firms.
Can you repeat the end of the question?
Do you have some result on the behavior of investment related to international reserve management for exporting firms? Firms that export and firms that do not export. Is there any difference in terms of reaction of investment?
A good point. I forgot to mention it. The results are more powerful for firms that are not exporting. And the results are also less powerful for exporting big firms. So this is the story that there may be selectivity. The big firms typically have mechanisms, once they are big and exporting, to hedge partially their exposure to this type of flaky volatility. And it's more the domestic firms that are impacted more favorably. But this is a very important point. I thank you, because I forgot to, in the rush, to mention it. Yeah.
Thank you for the excellent presentation.
Yeah.
So thank you for the very interesting presentation. So my question is quite simple, but I would like to share with you why I'm asking this question. In fact, you raised the example of China and of Russia. And those two countries use capital controls. So my question, why you didn't control, at least I missed something, why you didn't control for or use an index for capital controls? Because my concern here is that maybe this IRM accumulation or the active IRM is a result of those capital account management.
Okay, that's a good question, but let me make observation that I believe is correct, but correct me if I'm wrong. I think that Russia, until the onset of the events roughly less than a year ago, was quite relaxed in terms of capital controls because they accumulated huge pile of reserves. Now, the capital controls that Russia played is the result of all the interactions that started from February. And they played it in a way that, sadly or not, one should give credit to the top lady that is managing it, that prevented the collapse of the real exchange rate. And then it allowed even, with a lag of 2 months, a drop in the interest rate. So my sense, I will not compare China to Russia because Russia by now is a really commodity country. So a lot of the behavior of Russia, both in terms of accumulation or not, is simply the outcome of commodity terms of trade. Tell me what is the relative price of oil and gas, and Russia, with the exception of some minor sectors that declined, is really not a banana republic, but gas and oil. China is exactly the opposite. So the case of China is more complex because they, I think, have a multi-dimensional purpose in capital controls. Some of them are, again, I am guessing, I may be wrong, and if there's a Chinese expert, I'll be happy to hear somebody that worked directly. I think that there are 2 or 3 reasons why China is interested in controlling everything, including capital controls, on flows in and out. And this is related to the attempt first to reduce the transmission of outside shocks into volatility within China. It's fair to say that until really 2 or 3 years ago, it seemed to deliver. But I think that by now, with the COVID mess, it's entirely a new ballgame because they have a huge local exposure to the possibility of unstable real estate market, which used to be politically a very important mechanism in terms of both fiscal policy and redistribution from the center to the periphery of the states and the like. So I would say, at least that's my sense, that capital controls in Russia are following the Russian logic. China is flexible enough such that capital controls before the COVID crisis differ from the one that we have now, and time will tell to what degree they will enter into the possibility of a major challenge of capital flight if the instability of the real estate will continue.
We still have time for more questions. I believe there is one.
Yeah. Yes, so I think it's a very interesting paper. So just one remark. I think this development of sovereign wealth funds, it's something that was part of the prediction of this kind of model of reserve as insurance. If you have too much of them, then you should transfer them to a sovereign wealth fund. It's also clarified the insurance, reserve as insurance versus reserve as mercantilist. If you're a mercantilist, yeah, for sure you should buy foreign assets, but you don't necessarily need to buy short-term assets with negative returns. So somehow this sovereign wealth funds is also a clarification on the role of reserve. Now my question is more about, so if you think about reserve as a form of insulating countries for these financial shocks, then it's very different to what's happened even when VIX goes up, to what happened when you are in a financial crisis. So when you have these financial shocks, yes, you can lean against the wind, you can protect your countries, you can credibilize your fixed exchange rate and so forth. When you're in a crisis, it's a totally different game. Then it's about using your reserve to refinance the financial sectors, to open a special window so that firms with foreign liabilities can refinance them. So in somehow, I think your paper addressed very well the reserve policy in normal time and even in stressful time. But I think what's happened in financial crisis, in my view, is a bit different. And if you think about reserve as this kind of war chest of financial crisis, then I think it's a bit outside the scope of your paper, I would say.
I think that you're touching what I view are recent exciting or interesting developments, because it goes back to the original sin, if you recall, of Barry Eichengreen. So it turned out that the data, at least until 2 years ago, showed that there's mitigation of the original sin. So a lot of the old-fashioned hedging was related to the Russian story that if most of the external borrowing was in dollar, so it makes perfect sense for them to accumulate dollar like crazy. Now, Russia from 2014, in anticipation probably of what's going on, clamped heavily on external borrowing and moving away from the dollar into some euro, some from China, and other mechanisms. But it's not only Russia. You know, our ex-students that went to the Bank of Korea, he claimed that Korea also, by now, the stock market before the latest crisis of Korea was investable, and their local bonds are traded. So I think that now we are in a situation that some countries like Korea matured from a lot of this original sin. Other countries, maybe most Latin America, are stuck there permanently. So I think that there is a need to look much more carefully. Data is the issue. So now I'm working on a new project with the Asian Development Bank, and through them maybe we'll try to understand. My guess is that it matters a lot if you are dealing with a commodity country like Russia or Korea, which matured into becoming almost, before the crisis, as almost safe haven in the sense that their bonds became a mechanism that was viewed as a way to diversify. And Barry Eichengreen pushed the idea, which we started 3 years ago looking, that maybe before the crisis, more and more Korea type of countries became a way to diversify. And it's weird because I found from the Bank of Israel that they allocated some of the reserves into Chinese currency. So I think that this is the beginning of weird trends. It's hard to generalize because the big question that only 10 years from now we'll know to what degree the present crisis in Russia, between Russia and the EU and the US, may change the characteristics of the dollar dominance, which is really the big elephant in the room. That, you know, everything can happen, so let us wait patiently, but there will be plenty of room for exciting research in the future.
Okay, thank you very much.
Thank you.
Mr. Joshua Eisenman.
Thanks.
Now we will move to the second paper of the session. So the paper is on short-term finance, long-term effects, theory and evidence from Morocco. It will be presented by Kenza Benhima.
Okay, so I guess that I should also thank myself for including this paper in the program. So it's a paper on short-term finance, and we are trying to identify both the short-term and long-term effects. And it's joint work with Omar Shafik and Weixia Tang, who are in the room, who will answer the tough questions on the empirics, and Min Fang, who is stranded in Canada. He could not join. Okay, so in the literature there is a focus on finance and its impact on firm growth, but mostly on long-term finance. The focus of this paper is to look more closely at short-term finance and its impact on firm growth. So here, what we're going to document a bit the effects of the short-term finance. So its impact on firm growth, the mechanisms that are behind, but we're also interested in the policies, and in particular, some type of policies that have been really important now in emerging economies and also in developed economies is loan guarantee programs. And what we want for these loan guarantee programs is that they have what we call additionality, that they actually increase GDP, and that they are also more inclusive in the sense that they should target, in particular, small business. So we will pay particular attention to that. So we use a loan guarantee program, LGP, in Morocco, to document the effect of short-term finance. So first, what is short-term finance? Short-term finance is typically when firms have a credit line that they can use to finance working capital. So, for instance, pay the wage bill, pay their intermediary input, so all the costs that are involved in the short term in the production process. So it's different from long-term finance where you borrow typically to invest or to improve technology. So these are two different things. So what we find on this short-term finance and the loan guarantee program, how it affects the firm, is that first, we show that firms with guaranteed short-term loans decrease their cash ratio. So they change, to some extent, their financial structure. Interestingly, they do expand their production scale, even though this type of finance is not targeting at TFP or increasing investment. They still expand their production scale, and they do so persistently. Second, since we are also concerned on the participation of a small firm, we also look at participation along the firm, as a function of firm size, and we find that participation in the guarantee program is hump-shaped, meaning that actually the small firms don't select so much into the program. And we are going to think of what type of policies can help them select more into these programs. So first, we rationalize these findings in a heterogeneous firm model. So important ingredients to explain the facts is first, short-term finance fulfills, as I said, the need for liquidity, so typically working capital. Consequence of this is that once they get access to the loan guarantee, the firms can actually channel unproductive cash to productive assets, and this is already a channel of growth. And then there is a long-term effect as well, but we show that it's not obvious that finance has a long-term effect on the firm scale. We show something that actually has been in the background of the literature, but has not been put forward so far, is the role of what we call intertemporal distortion. So distortions that affect the intertemporal choices of firm, meaning the choice between dividends and net worth accumulation. And we show that this is important. So what we want to highlight is that it's not only the financial frictions that matter, but it's in an interaction between different frictions that actually affects firms. And to take into account the lack of entry of small firms, we introduce a flat entry cost. Then we provide a counterfactual analysis, and here, so there are different ways to expand a loan guarantee program. There are two main ways. So either you lower the entry cost, and actually here in Morocco there has been an effort in this direction. For instance, shortening the delays to acquire the guarantee and making it more simple for firms, so diminishing red tape. So we model this as lowering the entry cost. And another way is to increase the guaranteed ratio. And we show that actually, which seems a bit non-intuitive, is that both policies can manage to target more small firms, and in the particular experiment that we do with low entry costs, actually it turns out that it's the increase in the guaranteed ratio that is more effective in channeling more guarantee to the small firm. So I will explain this in more details in the paper. So, but before that, just to give, so I already talked a bit about this. So what we try to do in the paper is to show what drives the aggregate gains and the distributional effects of loan guarantee programs. And in a nutshell, so in the literature, both in the theoretical and empirical literature, the gains from loan guarantee programs are a bit elusive. So in the empirics, in some contexts they work, and in some contexts they don't work as much as we want. And in the literature, what has been shown is that it's also not obvious that loan guarantee programs have an aggregate effect. Why? Because of the self-financing channel. Basically, firms, if you give them enough time, they will at some point accumulate enough net worth to self-finance. So this makes the gains from loan guarantee programs a bit elusive. But we show that actually what can explain maybe this is that, well, depending on the context, you can have different intertemporal distortions. And these matter to make, guarantee program more or less, to determine the aggregate effects. And the key thing I will explain is that with intertemporal distortion, self-financing cannot undo financial constraints, right? Okay. Now, what we show, so we estimate the parameters in our model is that in Morocco, intertemporal distortions are large, so both the individual gains of entering the loan guarantee programs and the aggregate gains of enlarging loan guarantee programs are large. And yeah, as I said, the takeaway is that financial constraints interact with other frictions in the economy. And as I said, the distributional effects, just said that before, both type of policies increase participation. Okay, so we use the data from a loan guarantee program in Morocco. So some actors of the guarantee agency are here, so in the room. So it's Tamwinkum. It's this organism that provides guarantees. That's actually quite an old institution in Morocco. And in the last 10 years, they have considerably increased their portfolio, and they are actually quite active. So there has been a big expansion in this guarantee program. Unfortunately, here we don't have a nice RCT setup. Since it's a very big program whose aim is to be very inclusive, it's hard to find control groups, to really estimate the impact of the guarantee. But before I go to the estimation of the impact of guarantee, just a few words. So we use the data from this Tamwinkum organism on whose firm get the guarantees. And we use Orbis database, so we match that is a database that provides the firm level balance sheet data. That's quite a good coverage in Morocco, so we were lucky with this. So we match these two. We merge the two databases. Next, as I said, so we can have a selection bias here. And as I said, we don't have a nice RCT. We don't have an obvious controlled experiment that we can use. So what we do is we mix multivariate distance matching. So we try to find firm, pairs, to match each guaranteed fit with a twin. That we select based on some observable variables that are mostly the current and past year data on the balance sheet. And then we use a difference in difference. The goal is to look at the outcome of this guarantee program. So we apply the following regression. We have, I don't have a pointer, but it's okay. So the outcome variable is the change in the outcome variable, so typically sales, between T-1, so the year before the guarantee, and T+1, T+2, and T+3. And then we use group time fixed effect, the group being the guaranteed firm and its matched peers. Okay, and then we estimate the impact of the dummy which takes value 1 if the firm is guaranteed in year T. So this is what we do. This is what we get, and this gives us the first result. So first, firms increase, so the guaranteed firms, the firm size increases persistently once they get the guarantee. Okay, so we see that the impact here, 3 years after is still there, and the sales grow by about 12-14%, and still at 12-13% after 3 years. Same for assets, same order of magnitude. And if we look also at the inputs, so cost of employees and fixed asset is the same. It's exactly the same, persistent growth, same magnitude. So it's not firms that increase their, improve their technology. They really, it seems like the short-term finance is a bottleneck. It prevents firms from reaching a higher size. So what we find is that firms, do not increase cash holding. They do decrease their cash holding. Here, if you look at column 5, 2 years after the guarantee, but then they don't change their cash holding at all, which means that their cash ratio actually declines. So they use cash less intensively in their production. Current liability increase because, they get access to short-term finance, so that so they use this. So they use this. Opportunity to have more short-term finance. And finally, last fact is this: the fact that participation in the guarantee program is hump-shaped in firm size, and we see that actually medium and large companies are the ones that use more the guarantee, whereas small firms, are not do not get to use this guarantee as much. Okay, so first I'm going just to show you the mechanism in a simple model, focusing on what drives the long-term impact of the guarantee, what makes the long-term impact of the guarantee strong. So in this model, firms will solve 2 problems. So there is a static problem. And the static problem is about how they allocate their net worth between capital and cash. And then we go to the intertemporal problem where they need to decide how much dividend they distribute and how much net worth they accumulate for the next period. So we have a simple Leontief technology where they use capital and labor. Here the parameter A is the ratio of labor to capital that they use, so it's 2, about 2. There is a budget constraint where net worth N is split between capital K and cash C. Look here that they cannot use more funds than N, their net worth. So we assume that there is no borrowing constraint for long-term finance. Okay, they cannot borrow to increase capital. They can only use their net worth. So we just assume that there is no borrowing constraint for long-term finance, but there is a working capital constraint. So within the period, the firm needs to finance the wage bill, and for this, the firm is limited to its cash and to B, which is the short-term finance. So short-term loans that they can use within a period and reimburse at the end of the period. And then this is a collateral constraint. So this B, short-term finance, cannot be larger than a fraction theta of capital. And then the static optimization is like this. So they maximize the firm maximizes profits, subjects to the. So here you have a consolidated collateral constraint and the budget constraint. And then in a nutshell, so you can compute the marginal benefit of capital and the marginal benefit of cash. And then these two have 2 components. There is a real return. So there is, for the marginal benefit of capital, you have the real return of production that is high, so it's marginal return of capital. And then you have the shadow return of finance. But then this term is negative. Why? Because there is when you have 1 unit of capital, this means that you need also to hire labor to produce, and you have to hire twice as much labor than you have capital because A is large. But then because theta is low, typically below 1, it's true that this capital gives you collateral, but only little collateral. So the shadow return of finance for capital is negative. And for the cash is the opposite. The real return of production is 0, but there is a positive shadow return of finance because each unit of cash you can use also to pay for labor, and that complements the capital. Okay, so what's the impact of theta? So here, then so let me go back here. So you see that when you relax the borrowing constraint, when lambda goes down, it decreases the marginal benefit of cash and it increases the marginal benefit of capital. So that explains the fact that when you get access to the loan guarantee program, you decrease your cash and you increase your capital, which is represented here. So the capital to net worth ratio increases with theta, while the cash to net worth ratio decreases. And then because you can have access to more short-term finance, you can also increase, you can call it the productivity of net worth, so you can produce more. Okay, so that's the first set of facts, but what about, the long run? If the firms are able to self-finance, then giving access to loan guarantee program is just going to help firms get more quickly to their long-term scale, but it's not going to have very strong effects. So this is why the intertemporal problem is important. So here you have two frictions that affect this intertemporal choice. So the entrepreneur has to choose how many dividends they distribute. So they have a concave utility in these dividends, they consume it. And they have to choose between. So the profits has to be allocated between dividends, so that's the constraint there, and the future net worth. So two things can mess up with this program. First, there is epsilon, which is the exit rate. Okay, so each period, some firms will exit randomly. And second, there is a tau here, which we call, for lack of a better word, net worth erosion. So in reality, what is this net worth erosion? You can think of all the frictions that affect net worth accumulation. Well, this could be taxes, but you can think also of red tape. You can think of expropriation risk. So everything that gives an erosion of net worth. And then the other equation, you see that the growth of the dividends depend on this compound friction. But then that the multiplier of the short-term financial constraint is there as well. So forget about the frictions there in red and think of, when you have a binding constraint, when lambda is positive, what it means is that the marginal return to your net worth is high because we have low level of capital. So this means that when you have low net worth, you will be accumulating net worth faster. Okay, and then at some point you will outgrow your financial constraint because you will reach a level of net worth for which the constraint is not binding anymore. But then if you have these frictions, this means that you have also this saving motive for the firm that can potentially keep the net worth low so that you never outgrow your constraint. Okay, and this gives you this. So here we have the link, so the relation between initial capital stock and next period capital stock, depending on whether you have intertemporal distortions or not. And then in blue, you have the dynamics with the low theta, and in red with the high theta. You see that without intertemporal distortion, sure, when you get access to a loan guarantee, you will accumulate capital faster, but you see that in the long run, you get to the same level of capital. So this friction is not relevant in the long run. Well, however, when you have intertemporal distortions, you see that not only you will accelerate capital accumulation, but also in the long run you have a higher level of capital accumulation. So this is very important if because if the gains are only in the short term, they are much smaller than if they are in the long run, because then you have to compound over much more periods. Okay, so takeaway. First, you have the effect of a static choice of firm production and financing with an increase. So when you have a supply, when you have access to the loan guarantee program, you increase your capital, decrease your cash holding, and increase the firm's output. And if you have interval distortions, then you have also long-term effects on output. Finally, quantitative model, I will go a bit faster. So it's an extension of the simple model I've shown you. It's a heterogeneous production model where, as in the simple model, firms decide on capital, labor, debt, cash, and dividends. Firms face exogenous exit risk and have concave utility in dividends. There are some idiosyncratic productivity shocks. Short-term finance takes the same form with working capital constraints that are financed with short-term debt or cash. Some collateral constraints, the same as I've shown you, you borrow up to a proportion of capital. And a loan guarantee program where you have a fixed cost of entry. And what the loan guarantee program is to, the effect is to increase the multiplier on the credit constraint. In general equilibrium, since we want to look at general equilibrium, we also have other agents in the economy. You have an aggregate capital good producer, so the supply of capital will be endogenous. And you have other households that supply labor and consume. So we have a bunch of parameters to estimate. Some we fix, some we estimate. The moments that we match to estimate the parameters are some dynamic moments with output dynamics. This is mostly the persistence of the production process. There is some exit. The new entrants, we say that their size relative to average is 17%, which is exactly as in the data. There is an annual exit rate of firm that is also we directly take from the data. And then the other parameters, the financial parameters, the parameters of the financial frictions, for instance, we match by using financial variables. Finally, there are also some features of the loan guarantee program that come from the data. So where first there is a commission fee that the firms have to pay when they get access to it. So it has a cost to firms. And the percentage of loan guaranteed that corresponds to 60% of the loan. And then the percentage of firms participating, this we use to match the entry cost into the guarantee program. And finally, so we have the exit rate, but remember, one important parameter is the intertemporal distortion that depends on exit rate. This comes from the data. But then we do observe this long-term effect, and then we use that to match the net worth erosion, tau, which we find equal to 2%. So this gives us, so here you have the optimal decisions of the firms, so capital policy and cash policy for both guaranteed and unguaranteed firms. You see that for the firms with a high net worth, it doesn't make a big difference, but for low net worth, getting access to the guarantee helps firms to increase their cash, so increase their capital and increase their cash. Importantly, here you see that for intermediate levels of net worth, there is a level of net worth for which, getting access to the guarantee does not really increase your capital. Why? Because for sufficient net worth, and then you at some point have a binding long-term. So you have a no borrowing constraint. So that so at some point firms are not constrained anymore by the short-term finance. So they want to use all their cash because they can finance labor easily. They want to use all their cash, but actually they wish they would be able to use even more capital, but then they're constrained by their net worth. And this is why you have this plateau there, which is actually important to understand the impact of policies later. And this is the participation rate as a function of net worth for medium productivity firms and high productivity firms. And because you have a flat entry cost, you see that with the low net worth, this prevents actually the firms with low net worth to enter, even if they have high productivity. You see that they don't enter that much with low net worth. But still, so the firms that will enter more are the medium-sized firms and the high productivity firms. So those are the firms that will enter more, but the low net worth firms do not enter that much. Now we are going to look at the impact of expanding the loan guarantee program. As I said, there are two ways to expand loan guarantee program. You can lower the entry costs, and these are C1 and C2 policies. C1 is when the entry cost is 2/3 of the actual entry cost, and C2 is 1/3 of the entry cost. And C3 and C4 are based on increasing the guaranteed ratio. In Morocco, it's 60%, in the baseline, it's 60%. C3, it's 70%, and C4 is 80%. So first, let me look first at the aggregate impact, and let's just look at the changes in total output. And you see that increasing, so either whether you decrease the entry cost or you increase the guaranteed ratio, you increase aggregate output. So 0.28 and 0.39, it's 0.28% as compared to the baseline and 0.39% as compared to the baseline. This might not seem a lot, but remember, this is not a policy that is targeting growth. Okay, so it's only levels. And in macro models, it's quite hard to find figures that are as large, you know, quote unquote, as those numbers. Let me, before we go to the distributional impact, let me just disentangle a bit the effect of the intertemporal distortion. So when you compare the impact of C4 policy, which gives you a plus 0.32% increase in total output, to the same policy when you have lower distortions. And here we have the counterfactual with a lower tau, where we go from tau equals 2% to tau equals 0. So it's very small difference, but you see that the gains in terms of total output are halved. So this shows you that these other frictional intertemporal distortions are actually important, and they interact with financial frictions. Okay, so this here I don't know how much time I have. Okay, so no, that's perfect. So it's also interesting. So as I said, the goals of loan guarantee program is to have an aggregate effect to increase output. So that's overall additionality, but it's also, you know, we want to target small business. So we can compare the policies focused on entry costs and policies focused on the guaranteed ratio. One way to look at it is to look at how it affects the mean size of guaranteed firms. And these two policies are quite effective at lowering the average size of these guaranteed firms. But what's interesting is to look at the share of guaranteed credit. So how much of the guaranteed credit of the portfolio of the guarantee organism go to the first quartile, second, third, and fourth quartile. So very interestingly, actually, it's not if you look at the figures here, it's true that the Q1 and Q2 gets a higher share of the pie, but you see that it's quite small. And then it increases a bit, but you know, not that much in C1 and C2, so the entry cost policies. But the policies targeted as increasing the loan guaranteed, the amount guaranteed, are more effective into increasing the share of the portfolio that goes to the small firms, where we go from 1.24% of the total portfolio to 3% for Q1, and from 3.8% to 8% for Q2. So why is that? So for this, I have to go back to the policy functions. So so you can think of the difference between the red line and the blue line as commensurate to the benefits, to the profit, to the differential profit that you get by getting the guarantee. And then firms have to compare this to the entry cost. So if you lower the entry cost, all the firms that have a positive difference between the blue line and the red line, this will increase the participation whenever you have a difference between the red and the blue line. So this is quite large. But increasing the guaranteed ratio, you see that, so if you increase the guaranteed ratio, it's going to move the blue line more on the upwards, but you still have this plateau. So who are the firms that are going to enter if you increase the loan guarantee, the guaranteed ratio? It's all, merci. Thank you. All right, so it's all the firms that get a positive benefit of guarantee. But you see that the firms here that already, when they get access to the guarantee program, get to the plateau here, if you increase the guaranteed ratio, you're not going to increase the benefit for this firm. Because anyway, even with the 60% ratio, they were already, they were already happy. They were already able to hire as much labor as they could, given their long-term borrowing constraints. So the increasing the loan guaranteed ratio actually affects only the firms that are up to this level of net worth. So it's more tilted to small firms, and this is why it works better to target more the small firm. That said, I think we should not compare what we do in the counterfactual to what the TAM Wilcom actually did, because they did try to lower the entry cost, but they did this in a smarter way than we do it in the model, in the sense that what they try to do is to limit red tape for small loans. So they decrease the entry cost, but in a targeted way. Here we decrease the entry cost, but for all firms. So in real life, actually, lowering entry costs, as long as it's targeted to small firms, can actually help to target better. So to conclude, so we studied the effect of short-term finance on firm growth and its aggregate impact. We found that firms with guaranteed loan expand their production, scale persistently, and decrease their cash holding. And quantitatively, we showed again, enlarging the loan guarantee programs, that they are substantial, but there are the difference between these two policies. And we highlight the role of intertemporal distortion. So I will stop here.
Thank you, Kenza. The paper will be discussed by Francesco Papada.
Yes.
Okay.
I'm not in the room. Can you hear me?
Hi, yes, we can hear you perfectly.
Okay. Should you put the slide? Yeah.
Yes, we can see the slides.
I cannot see the slide. Okay, perfect. So let me start by thanking Kenza for inviting me to this conference. Unfortunately, I couldn't come in presence. I really regret it. I hope I have a new opportunity soon. So it has been a pleasure to discuss this paper by Kenza and co-authors. Let me start with the, so somebody should move the slides. I can't control from here, I guess. Okay, thanks. So what is the research question here? So Kenza did a great job at presenting the paper. So it's very easy. The question in this paper is try to test whether this guaranteed short-term loans program that was implemented in Morocco has allowed small and medium enterprises to get access to credit and then allow them to grow more. So this is relevant for an emerging economy because we know that financial constraints can really limit the optimal size of firms and therefore limit also growth and being detrimental in terms of welfare. So it's very applied to the case of Morocco because of the data they have. Next slide. So just to do a summary of the paper, what they do is to directly have a look at the effects of the working capital loan guaranteed on firm characteristics, and then study, so first establish some empirical facts, then build a model to study some counterfactuals and the aggregate implications. So in practice, this, next please. This means that they first provide evidence on 3 empirical facts, looking at firm level data on 2009-2019, and as Kenza said, this program has been used by many firms, so they had really to think about the way to do a difference in difference approach for checking the difference between control and treated firms. Then, as I said, they build a model with heterogeneous firms. They have first a simplified version where they can draw analytical results, and then they took it to the quantitative results where they have a model with heterogeneous firms, collateral and working capital constraints, and they first showed that this model can rationalize the main empirical findings, and then, thanks, good timing, and then they can use it to run counterfactuals and show the role of lifting each of these constraints, both across the entire firm size distribution and then the implications for the aggregate economy. Next. So what are the empirical results? As I said, there are 3. So first, firms that have access to the guaranteed short-term loans decrease their cash ratio. They expand their production scale on impact and over time, as been shown by Kenza. And another fact is the fact that the guarantee program, if you look at the participation rates, and if you look at the graph with respect to firm size, looks ham-shaped. So this was kind of surprising, and they have an explanation for this. What are the model results? Instead, first is the fact that they can rationalize this ham-shape, for instance, with size-dependent collateral constraints and the presence of a fixed participation cost. And then they can, as I said, use the full model to show, by using some counterfactual, to what extent the expansion of the credit guaranteed programs can increase growth and generate more welfare gains. And in particular, they focus on 2 different counterfactuals. One, when they increase the amount guaranteed, and the other one where they instead decrease the participation cost in order to allow more firms to get access to this. So this brings me to the main comments. So first of all, is about cash holdings. So this is one of the 3 empirical facts you establish. But next, please. But what I would say is that the presence of a large cash holdings can denote the presence of credit frictions, as we know. But I would say that this is not a specific feature of emerging economies. In fact, we see huge cash holdings by firms also in developed countries. So I was wondering whether this is a crucial fact that you want to show. In particular, because when then you look at your evidence, for instance, the very first figure, you show that when you show the difference between the control and treated firms, you see that the difference between the 2 is very large. It seems to be constant both before and after the treatment. So it looks like there is these firms were behaving in a different way in any case with respect to cash holdings. And then there is also in your empirical results, so next, in your table, it has been shown that you say that we observe a stagnation and a weak decline cash for guaranteed firms. But in fact, if you look at table 3, you see that the result is significant only at time t+2, not at time t+1 and t+3, and it's also barely significant. So since it doesn't seem to be a robust evidence on that, I was just curious about why you stress this fact, which is probably not the main finding. Then next, my probably more important comment is about informal economy. So as also the general director of Bank Al-Maghrib said yesterday in the introductory speech, Morocco as well as developing economies are concerned with the size of informal economy. And this can be very relevant for the type of mechanism you're showing. So next. If you want, what really matters in this kind of countries is the number of firms at the margin of formality. What I define as the number of firms at the margin of formality are those small firms that probably have a trade-off between having access to the financial market or not having access to the financial market and staying formal. And the trade-off is such that if you want to access to the financial market, you have to be more transparent. You have to produce some accounts, to show your books, etc. And so what is the cost of doing this? Then you have a higher tax burden. So for this type of firms, you really have this trade-off. And then lowering the constraints actually allows them to have access to the market. And so if the cost of having access to credit is really high, then if you decrease them, for instance, as this program can do, then you really encourage this firm to become formal. Okay, and so I think that in that respect, you should probably control for contemporaneous tax reforms. For instance, if there has been a corporate tax or a VAT tax that actually can have an impact on this trade-off of firms and on this decision to become formal to get access to the to credit. So next. So what I also think is that probably if you were to take into account the presence of informal economy, this could provide you an alternative explanation for the reason why the participation rate is ham-shaped. So basically what you observe for small firms are those firms that are at the margin of formality. And that's the reason why they participate less to the program. And then you can think about what tax changes in the tax rate can affect this, the share of participation among them. Okay, and then this brings me also to another question, which is what you show in this ham-shaped figure is the final outcome. But I don't know to what extent this is due to the supply and to the demand of guaranteed loans. And in particular, which firms are eligible. So at some point, you can go to the next slide. At some point in the paper, you talk about the eligibility, but I did not get exactly probably what is going on here. So what I understand is that firms can demand access to these guaranteed short-term loans, but then you say that only those that are eligible, then they really get the loan. So in that respect, I guess this is a crucial point. So next. My question is, what determines the eligibility? Are there some conditions that needs to be fulfilled? And then if it was possible, and if you had the information about that, it would be nice to see what is the pattern of firms that asked for the program. So they applied for getting access to this credit, but were not considered eligible. And so then it could probably provide an additional diff in diff exercise. Next. And so I think that these questions are relevant for the model because if eligibility is important for having access to credit, then first of all, the selection is not orthogonal to some firm characteristics, because if you have to fulfill some condition to get access, it means that the firm characteristic tells you if in the end you will get access to this, and that if it is the case, the hypothesis of an uniform fixed participation cost is probably not appropriate. And you can think about other mechanisms that deliver this, including the one that I just said, like the informality, the presence of informality. Next. So about additional comments, I was wondering about, we talked about the counterfactor. They clearly show that if you expand credit guarantees, then you increase firm growth, increase welfare. But something which is related to what I just said about eligibility, if I was wondering if there is any adverse selection effect that one should consider. So what is the cost of increasing guarantees, both, I would say, at the intensive margin and extensive margin? By intensive margin meaning the share of the credit which is guaranteed and the number of firms that get access to this, if there is any adverse selection effect that we should consider and the cost associated to this. And the next small comments, again, there are some evidence about different results, different timing on asset growth. I was wondering whether there is a specific reason, or again, this is just something that you find. And then I would also add a few other comments based on your presentation. You have insisted on the intertemporal distortions and this dividends versus net worth accumulation, but you know that in the literature, taxation plays a big role in that respect. Whereas the model just talk about this net worth erosion that could include taxation, but it's not really clear what it is about. And another point, small point I would like to do is about the role of the joint distribution of net worth and productivity, which is not discussed in the paper. And finally, I was not sure whether you only consider log utility or you in the more general case or not. And then there are some minor typos, as I wrote in the slides, about the reduction, but I understand this is the first draft, so I'm sure it's nothing serious. So to conclude, next slide, it's the last one. What this paper does, it exploits firm-level data for an emerging economy to explore the effect of larger guarantees on short-term credit of firms. What they find is that there are important consequences of expanding this credit program. And in the end, one just last question I would leave for discussion is the role of the costs of raising guarantee credit to all firms. Are there any costs associated to adverse selection, etc.? Apart from that, the paper is very well executed. The model is nice and replicates the empirical findings. And it was a pleasure to read it. Thank you. Can you hear me?
Yes, thank you,
Okay.
Francesco, for a great discussion. It's really a pity that you cannot be here, but it's good to see you anyway. Okay, so
Same here.
There are lots of questions. I'll do my best. Yeah, it's true that the cash holdings. So this is a figure I did not have time to show because we look. So we do this matching, and we managed to find quite resemblant pairs to the firms, except for the cash. There is a big difference in terms of cash, and this is something that is very persistent. The thing is that there is no different trend in cash before. So the pre-trends are similar. We do our best to find really pairs that are really similar ex ante. So for this, we are really limited by the the fact that the program is very wide and inclusive. So yeah, So for this, we just do our best. And something to mention, and it's also linked to one of your other comments, is so to be clear, what we do with this empirical exercise is to have some motivating evidence. And then in the model, we use a whole range of moments in the end. And the long-term effect, I mean, we compare our empirical exercise we match it to a similar exercise in the model. And in the model, you do have also some amount of self-selection, because firms choose to get into the program. So we try to match what our empirical exercise in the data to similar exercise in the data that has, we believe, similar drives, in particular the self-selection. So if there is self-selection in the data, there's also self-selection in the data. So we use this as a moment to match. So I think the model should not be as plagued by the the endogeneity of the results and the self-selection result that we have in the data, because it's a limitation to our exercise has some limitation, it's true, in interpreting our results in terms of causality. But I don't think it's an impediment in terms of, like matching the parameters in the data, because we treat the data exactly as we treat the model-generated data as in the same way as we treat the actual data. So I think this is actually a nice, in my view, way to use the model, also to control to some extent for the selection that is in the data. But we don't deny that there is selection in the data. What is a good sign, at least, is that the results, the long-term results that we find in our firms is not driven by TFP. So these are not firms that have like an opportunity to increase their productivity and that then ask for the guarantee. At least we match firms that are similar in that respect. Okay, so you have comments on the informal economy, and these comments are very well taken. Here, we have a bit the limitation of using administrative data, is that by construction we have the firms that also self-select into being in the formal economy. And in that sense, if you look at our hump shape, the lack of participation of small firms is the participation of small firms that we find in our administrative data, I think, is an upper bound to the real participation, because those that we don't have in the data are those that also are firms that also not participate because they are not in the formal economy. I think we only understating the lack of participation or using our data. I think your suggestions on using tax reform and informality is a big issue in Morocco that we don't really address that. We don't address directly here, but I really like your suggestion on using tax reform. This is definitely something we will think about. So thanks a lot for the suggestion. And you asked a question on the eligibility of the firms. So here I can tell a bit more how it works. So the data that the Tamwilkum agency gets is balance sheet data. So the criteria to get the guarantee are really based on balance sheet data, which is the same data that we actually have. The selection of firms into the programs does not take so much place at the level of Tamwilkum, but more at the level of the banks. So when I talk with people at Tamwilkum, they say they rarely have to refuse an application that comes from the bank, because the banks already do the screening. And the type of screening that the banks do, we don't know, in fact. So that's also a limitation. Yeah. About the cost, so a very relevant comment is, what is the cost of guarantee? So we in this paper, we highlight the gains. And then there is something that is not in the paper, and I should have been clear on this, is the cost, because there are potential costs. We try to look at the exit rate, so how, like firms that get access to the guarantee, do they exit more? We didn't find significant results. So, but our exit rate is something that is not very clear, because these are firms that drop out of the data set. Some do this because they go bankrupt, but some do this just because they go back to informality. So it's not clear, what type of exit we are observing. And this is something actually we want to address in the future. We're trying to get access to credit bureau data to have more information so you talked about adverse selection. So firms do self-select, are they of some types, but also moral hazard is important. We want to see if those that get the guarantee, they also default more. And for this, we will hopefully be able to use credit bureau data to explore more the flip side, which is the cost of the guarantee. Yeah, so I stop here. There are many other comments, but I think I need to look more closely at those.
Thank you very much, Kenza. The floor is open for questions.
Thank you, and thanks for this great presentation. It seems, if I understand it well, it seems that in the model things work through quantities, the quantity of credit available, the quantity of cash that the firm has, and not so much through prices. So I was wondering if you had, evidence on the interest rates of those loans, on the interest rates on cash, and things that could kind of motivate this. Because you might think of prices to play a role as well, and at least in theory, where if it's costly to get this short-term loan, and the optimal scale of production is going to be a function of the interest rate of this loan, and then even it's not going to be optimal to overcome this borrowing constraint by accumulating cash if the return on cash is lower than the shadow cost of it. So even in the long term, you might not need an intertemporal friction to get this kind of result. But then again, I guess it's an empirical question, whether this matters or not.
Shall I answer already? Okay. Yeah, unfortunately, we don't have data on interest rates. But you're right, because the access to the guarantee affects also the interest rates, and that's also important for the intertemporal distortions. Hopefully, if we have access to credit bureau, we can see more. They do pay a fee, so that increases the cost of finance for these firms. Yeah.
What are the other requirements?
Sorry, I have a more direct question, simple question. Which kind of recommendation for the decision maker can you propose?
Yeah. So to be honest, to really be able, it's a bit self-defeating, but to really be able to make recommendations, we need to look at the costs. Yeah, and this is on the agenda. Does it affect the probability of exit of the firm, the probability to default, So this. We have shown the bright side of the credit guarantee, but for policy recommendation, we are, that's why we want to look more closely at the costs. If you abstract from the cost, then it depends on what's the purpose. If the purpose is to increase GDP, then expanding the loan guarantee program either through increasing the guaranteed ratio or decreasing the entry cost work. But then for distribution, if you want to target more to small firms, then you have to look more into the details of the policy.
What are the requirements for firms that want to access the guarantee? What are the requirements for firms that want to access the guarantee?
So what are the requirements of firms who get access to the guarantee? Now, once they get access to the guarantee, they have to pay a fee, and that's, to my knowledge, that's the only requirement.
There's no collateral or anything like that?
Well, the purpose of the guarantee is to provide collateral to the firms. But since it's only 60%, firms still need to have skin in the game. So they need to provide some of the collateral. It depends how much collateral the bank is asking. Typically, it would be more than 60, but the firm will still have to have some skin in the game. Yeah.
So you have one question and one comment. So one question is, I think in your regression, you put this kind of group time fixed effect, which means that you look at the effect of firms within groups, no? So that's something maybe you could clarify a little bit. The other thing is that well, it's not clear here. There's a cost, but there is also a subsidy element. Who captured subsidy? Is it captured by the firm or is it captured by the bank? I think it's not totally clear. And then maybe we can look also in alternative policies, like in France, we have the BPI, who is actually injecting equity in those small firms. So I think that will be an alternative way of of using counterfactual, not only looking at what they could do to expand this program, but maybe what alternative program could bring for firms of different size. I think here you don't have to limit yourself in some sense to this.
Okay, so I answer to Romain first. Yeah, I think it's very, so who benefits from the guarantee? I think it's a very, very interesting question. And the question, it's linked to the question of, why do banks not, do this already because it's so beneficial? So that I don't have the answer, but I think this is a great question that we should address and see what are the frictions also in the market structure of banks that are relevant to explain why banks actually are socializing this why should it be the sovereign that is taking the risk? And I think this is really deep, and I don't have the answer, but I think we should look into competition within the banking sector. There is somehow some what the result shows is that there is some risks that the banks could take that are actually they don't take. Yeah. And thank you for the suggestion for looking at the BPI.
So we have room for one question.
Thank you for your presentation. So I have two questions. First one is about whether the exhaustivity of the 1.5 million firms database was used in the study, and if so, I was wondering how did we ensure whether these firms are active. I guess the 1.5 million firms includes creators and failures. So, thank you.
So we kept only firms who had balance sheet data. So I think that ensures that we have active firms, because it's true that you have sometimes firms in this trade register that are kept for a long time, but we made sure that they had balance sheet data. So I think this is, enough to be sure that they are active firms.
So all the 1.5 million firms are used.
Okay, so we did the matching. So 1.5 million is the initial data set, but then we narrow it down because precisely we have this requirement that we need balance sheet data. So it's not the 1.5 million that have balance sheet data.
Please.
Okay, thank you.
I wanted to ask one comment.
Sorry, something I wanted to mention is that the 1.5 is the firm time observation. So for each period we had more, the number was more like 150,000 firms.
If it's allowed. Just a suggestion about, because I don't know if the data allow it or not. Link it to the question of self-selection, risk of and also homogeneity that was raised by the first commentage about the characteristic of the firm. The idea is that ideally we know the firm's 3 stages in the study. First one is who knows and who don't knows this kind of guarantee. Second, then for those who knows, who apply for, who not apply for. Then at the end, impact for those who apply and get access. Because I think it's very important to know what is the role of the bank, which is like a screen between the organism of guarantees and the firms. This is one question. The other one, maybe because I have many questions, is the control variables. Thank you very much.
Okay, answer one on the controls variables because it's the easy one. So since we use matching, we match firms that have similar characteristics. So in principle, we don't need control. And then this will help me also answer Romain's question that I forgot to answer about the group time fixed effects. So two things. So we match firms that have very similar characteristics in terms of balance sheet. So we could add the balance sheet variables as control, but it will not really help, fit the data because they're already similar. And then we have the group time fixed effects, meaning that we have a fixed effect for each period and each group of firms that are, that we match together. Meaning that since, any developments that is common to that group of firm will be taken into account. Yeah. And again about self-selection, we don't know exactly how banks select the firm. So what they told us. So some banks are more or less active in this program. The ones that are, what they told us is that they will submit firm to the program whenever the firm has the need of liquidity but doesn't have the collateral. And then what also exists is that not all banks are as active in this, so this can maybe generate some heterogeneity in exposure that we might capture by using our matching procedure. So no, apart from that, I don't know. I cannot say much more about this.
Thank you, Kenza. I know there are so many questions about this paper, but we are unfortunately running out of time. So we'll have a 20-minute coffee break. Please try to be back by 11:50 so that we stay on schedule. Thank you very much. The next paper, we will try to be on schedule on this one. So the paper is on microequity and mutuality, experimental evidence on credit with performance contingent repayments. And we will start with Mr. Mohamed Meki.
Okay, thank you very much. Thank you to the organizers, participants, and really enjoyed this conference. Really enjoyed everything today, although I feel like we've drifted away from Uganda a little bit this morning, right? So let me try and bring you back to East Africa, to somewhere not too far from Uganda, also known as Kenya. Okay, so this is a setting with one extremely large firm and lots of very small firms within the supply chain of this extremely large firm. And so the motivation is that fixed asset investments often come with high expected return, but also greater risk. Equity-like contracts, by equity-like I mean those with performance contingent repayments, may provide a more appropriate level of risk sharing than very rigid debt-based contracts, but it's quite hard to implement, especially with very small firms, because of costly state verification. How do you know what the performance of these very tiny firms is? Now, fintech firms in high-income countries are increasingly using high-quality administrative data on transactions to provide something that feels equity-like performance contingent financing and using high-frequency recent data sources. And so in this project, we explore whether large firms can use high-quality administrative data to provide performance contingent financing for productive assets for their micro-distributors. So many large multinational firms operate what's known as a route-to-market program. And these are programs often in low and middle-income countries where they rely on a network of very small distributors to get their final product to the customer, often customers in informal areas, etc. And these informal small micro-distributors often rely on this extremely large firm for a large share of their income. In many such cases, these suppliers have increasingly detailed data on sales for these micro-distributors, and an interest in increasing the distribution of their own product, which increases the incomes of these micro distributors through a provision of a productive business asset which can improve performance. Now, if you're reminded of the presentation yesterday, there was also a similar setting where there is a very large firm which distributed bread and other products to retailers, and this is a very similar setting. So we implement a field experiment with one of the largest manufacturers of food products in the world, who we're just going to call Food Co, and they produce chewing gum in Kenya. Just like Uber Eats, Deliveroo, and other firms, they rely on this large group of informal micro-distributors to get their products to the final customer in often informal areas. They also sell to supermarkets, etc., but they sell to many final customers through these micro-distributors who are moving products from small warehouses, small stock points, to end customers. And often these micro-distributors need to transport a large amount of stock to sell their products, and they do so on foot. Many of them do so on foot, and it's quite heavy. And so there are, as I said, one motivation for this project is that performance contingent financing, where you explicitly share risk through the financing structure, may facilitate higher risk, higher reward investments. And so we think this is an ideal setting for testing the viability of performance contingent financing, because there's a higher expected return to a lumpy fixed asset for these micro distributors. There's excellent administrative data on purchases of stock, which, similar to the presentation yesterday, one can use to have some measure of profit that's not subject to self-reported biases for these small micro-distributors. And it's a homogeneous good. So it's chewing gum that they're selling. We know how much they're selling the final chewing gum product, so we can estimate profit for these very small micro-distributors. We partner with the local microfinance institution to finance an asset, and this asset is going to be a bicycle for these micro-distributors, and we're going to investigate alternative financial contracts to finance this productive asset. Some of them are going to be performance contingent in nature, using the administrative data to link repayments to performance. So to summarize results, we find large positive impacts, especially of the performance contingent contracts, on the business profits of these small micro-distributors. We also find evidence of spillovers, positive spillovers, which I will describe shortly as a surprising finding. And we find little evidence of adverse selection and moral hazard. Now, often if you think of sharecropping or these kind of contracts where you're taxing someone's output, you may think that there are significant challenges due to moral hazard, and no doubt there are in many settings, and also problems of adverse selection whenever you offer equity-like contracts in which there is some degree of sharing of profits and losses. We find little evidence in this setting of adverse selection and moral hazard, and we have a simple conceptual framework to try and explain why we think that may be the case. In short, in the model, in a setting where extra effort is also more risky and investment increases your expected return, but also the riskiness, you could actually have performance contingent contracts crowding in effort on the good that's being taxed, which is opposite to the usual story in sharecropping. So related literature, there's as I said, many large multinational firms are increasingly selling in low and middle income countries. They're consumer goods, and often they're relying on these small micro distributors to get their products to many of the customers. There is not that much literature on supply chain financing in developing countries that looks at like causal evidence, despite the significant mutual benefits for both the micro distributors and the large firms. There is a large literature that emphasizes the strong theoretical justifications for why suppliers can act as financial intermediaries due to their comparative advantage in assessing client performance, creditworthiness, and also their ability to use informal means to guarantee payment. So if I'm a supplier of a supplier of the stock for these micro distributors, and I provide them with financing and they fail to repay, you can use the threat of cutting off the stock to increase repayments. And of course, others have done a lot of work on relational contracting, Amit and Rocco and others. Okay, so also this relates to the literature on microfinance and the ability to design better financial contracts for low-income micro-enterprises. Many of you would already be familiar with this literature, but despite the high returns to capital shown in many micro-enterprise studies that just gave people cash or capital, the results from microcredit have been quite disappointing in terms of zero average effects, although there is some evidence of heterogeneity and some general equilibrium effects. And there's exciting second wave of the microcredit literature that takes the very rigid conventional debt contract and it allows a little bit more repayment flexibility. And there are some very exciting results there, among them George's work in 2021. Now, equity-like contracts also increase the flexibility of repayments of microcredit contracts, but do it by explicitly linking the repayments to the performance of the small business. And they can incentivize greater risk-taking compared to a standard debt contract through the implicit insurance that they provide. But as I said, they are problematic to implement in many settings due to costly state verification, like how do we know the performance of these small firms, and usual kind of stories of adverse selection and moral hazard, and particularly in low-income countries, issue to do with the legal enforcement of ownership claims. Like you could take a stake in a small firm, but how are you actually ever going to enforce that? And there's this interesting, very small-scale pilots by Demel, McKenzie, and Woodruff, where they implemented small-scale micro-equity investments with venture capital in Sri Lanka, and they were just really struggled to repossess assets, even when there was enough money to pay for their financing. In our experiment, we make no attempt at all to own a share in these small micro-enterprises. I'm just calling it equity-like for some of the contracts in that there's performance-contingent repayments, but we're not actually owning any of the small businesses, and we're using a measure of profit, which I'll explain shortly, but it's basically sales minus the main cost of goods sold, which is the inventory cost, which we observe via the administrative data for the large firm that we work with. Okay, so this is the setting with a diagram. You have the large multinational which produces chewing gum. It has these distributors who sell to these stock points, which are these like small warehouses. There are probably around a couple of hundred of those in the country. About 70 of them are in our project. And then you have the micro distributors, really tiny kind of distributors, hawkers and uplifters. So you may have seen these in many countries. Hawkers are people who sell you stuff outside of your window, in traffic, on buses, etc. Uplifters actually take it from the stock points and go and sell it to a small kiosk which sells to the end customer. And so we work with both of these types. So this project actually started from based on qualitative work that my co-author Kate had done through the business school, who approached this. The large firm approached the business school saying, we want to go beyond CSR, beyond corporate social responsibility, for improving the way that we interact with the stakeholders in our supply chain. Now, you may look at this setting and say, the best way for you to improve the lives of these small micro distributors is to give them employment contracts, to give them health insurance, to help them. They weren't going to do that, right? But they said, okay, we will consider ways for helping them with an asset. And so that's how this project basically came about. And qualitative work, which suggested that many people are complaining about having to transport large amounts of stock on their backs. And so bicycles were identified as an asset that could be beneficial for a large number of these individuals. However, good quality work bicycles are often quite expensive in this setting for these people, about $100, which is not trivial for this sample. And so our sample of micro distributors are individuals who expressed an interest in purchasing this bicycle, this asset, for their small distribution business. And so we're going to finance this asset using a randomized control trial using 4 different types of financing contract. In each of these contracts, the individual, the micro distributor, would put up a 10% deposit, and then we'd finance the remaining 90% using 4 different types of contractual structure. One is a very kind of standard debt-like structure, which is just fixed repayment every month for 12 months based on a simple interest rate of 15%. Second is something that we're calling equity. As I said, it's not equity in the sense of owning a firm. It's just performance contingent repayments. So payments that are linked to their profits, and we have a measure of profits which we build based on our administrative data. And so this is a fixed duration contract over 12 months where they share a portion of their profits, like 10% of their profits per month, and they pay a small fixed amount, which is half of the fixed amount of the debt contract, which we calibrated so that it was, in expected cash flows, a fair horse race between the debt and the equity contract. Under such a contract, if they're very profitable over a 12-month period, they end up sharing a huge amount. And if they're very unprofitable, they end up paying a much lower amount. So there's full kind of risk sharing, upside and downside. We also have a contract which we just call a hybrid contract, which has the same repayment structure as the equity contract in that every month they pay half of the fixed payment of the debt contract and 10% of their profits. But that contract continues to exist until the nominal amount that they've paid is the same as the nominal amount under the debt contract. So if they have very low profits, they keep just paying small fixed payments until the contract terminates after 2 years. And if they have very high profits, they could end up owning the asset within a couple of months, right? And so this contract is kind of like a flexible duration debt contract with the repayments structured as performance contingent payments. And then we also have something called an index insurance contract, which I won't spend too much time on, but it's similar to the equity contract in that it's a fixed payment and a flexible payment, but rather than it being 10% of your own profit, it's 10% of the profits of everyone else in your area. And we observe the administrative data for everyone in this program, whether they're part of the experiment or not. And so it shares features with area-based yield insurance. It also shares a lot of the problems with index insurance of basis risk, which I may discuss later. Control group is business as usual, so they just continue being part of this micro distribution program for this large multinational without having any additional financing contract. And so this just shows you a summary of what the payments look like under the contract. If you have no contract, the purple, you make no payments at all. If you have the debt contract, your payment does not vary at all based on your profits. You just pay a fixed amount regardless of your profits. If you have what we've called the equity contract, it's just a linear function of the profits. Profits are really high, they pay more. Profits are less, they pay less. And the hybrid is somewhere in between these. It's slightly concave because, as I said, there's a flexible duration. And so if you earn very big profits very quickly, you pay off the contract very quickly, and in net present value terms, you actually end up paying more than the debt contract. Similarly, if you have very low profits, in net present value terms, you end up paying less than the debt contract. And so between 2016 and 2020, you had just under 500 micro distributors who were part of this large multinationals route to market program. And we have daily data for all of their purchases of chewing gum. And they have 6 varieties of chewing gum, but I won't bore you with details of like mint chewing gum versus fruit chewing gum. I don't think anybody other than me cares about this. But basically, we have aggregated daily data to monthly level. And so we have around 1,700 unique micro distributors who are in this program at any given time. The experiment is with a small subset of those. It's with 161 people who expressed an interest in expanding their business with the purchase of a bicycle. We'll use the larger sample for our spillover analysis. And so these are people who are about 30 years old, average profits about $100 per month. About half of that was from the exact product that we observed the sales for, which is the chewing gum, and about half of it is other products, which they're selling, toiletries, drinks, etc., which we do not observe. So the first thing that you probably should have in mind here, we're going to be providing some contracts with performance contingent repayments based on a measure of profits, based on stock of a certain product that they're selling, but they could also sell other products. So you may have in mind that they could start selling the other product as soon as we start taxing their first product. And these are micro distributors. I mean, median number of employees is 0. And we have lots of evidence suggesting that they are quite liquidity and credit constrained. Average income and consumption are quite close per month. And so these are individuals in our experiment who expressed an interest in purchasing an asset for their business. They come to a workshop, they do some behavioral games, they complete a survey, introduced to the 4 different microfinance contracts, and then there's a public randomization. And so we take their preferences for each of the contracts using a strategy method, and then they draw a ball from a bag and they receive one of the contracts and sign it with the MFI, who takes the final contract risk and responsibility for collecting payments. So although I've described this as a large multinational, micro distributors which were within the supply chain of the large multinational, we actually brought in an external MFI to provide the financing here. And you may think of other optimal models of doing that in other settings. So just like a simple conceptual framework to think through what mechanisms could be at play, I'm going to show you that the performance contingent contract led to good performance for these micro distributors and didn't lead to the kind of side selling or moving away from the product that's being taxed. And this is a very basic framework just for thinking how that could come about. And so this is a setting in which greater effort leads to greater expected return, but also greater risk. And so these people are selling often in informal areas, slums, difficult to reach terrain. And so by exerting extra effort to reach new markets, you have higher expected returns, but it's also risky. Many things can go wrong. You provide a bicycle for any given level of effort, it increases the expected return, but there's also greater risk. Somebody could steal the bicycle could break down, you try out new customers, maybe you lose some of your old customers, maybe the things don't go wrong. So this is a risky environment. We have a framework for thinking about how a micro distributor, a credit-constrained micro distributor, could maximize their utility and how they think about choosing how much effort to do on contract, which is the good that we observe, the food core product, which is the chewing gum, versus off contract, which is all other products. So they choose EC, which is the effort of on-contract activities, and EN, which is the effort of off-contract activities. So the profit is a simple profit function which is multiplicative in effort E and also productivity shocks eta, And so this captures the idea that greater effort also comes with greater risk as well as greater expected return. Kappa is the amount that your return or your profits increase from the provision of a bicycle. So it's equal to 1 if you're not offered, if you don't have a bicycle, and it's greater than 1 for bicycle. And so if you look at the utility function, you have this profit that comes from the on-contract and an omega term in front of it. And so for the performance contingent contracts, omega equals 0.9. We're taxing 10% of their profits from on-contract. If they're under the debt contract, omega equals 1. They have their profits from N, which is off-contract activities. There's a cost of effort versus on-contract versus off-contract, constant elasticity function. And then there's also this term F in the utility function, which is the fixed payment under a debt contract, and also half of that under the performance contingent contract. We use a simple kind of constant absolute risk aversion utility function and normally distributed productivity shocks. Let me just summarize for you I already described the repayments. Let me just summarize for you some of the findings or the kind of insights from this framework. So this is a situation in which you basically force someone to be under a debt, abstracting from selection across contracts. So if I force someone to be under a debt contract, how do they choose effort on contract versus off contract? And if I force someone to be under an equity contract with performance contingent repayments, how do they choose on-contract effort versus off-contract? You'll see that where returns to capital are high and individuals are risk-averse, there's higher effort on contract under equity compared to debt, which is not the usual story that you would think of as performance contingent contracts with a big moral hazard issue. And no doubt there could still be some moral hazard thing going on, but because of the riskiness of this environment the equity-like contracts can actually crowd in effort on the product that's being taxed. And then this is looking at the preferred contract. If you allowed people to select across contracts, if there's very low returns to capital, nobody would choose the contract at all. And then when you introduce the equity and the hybrid contract, individuals who are more risk-averse in a situation of high returns to capital, they would prefer that over a debt contract. So just to summarize the implications, the performance contingent contracts can actually crowd in on contract effort relative to a debt contract because this bundled insurance allows you to increase the marginal product of effort, which can potentially counteract any moral hazard issue from taxing entrepreneurial success. Implicit insurance of performance contingent contracts should be particularly attractive to individuals who are risk averse. And we do measure people to be risk averse on average using a variety of behavioral games at baseline. And so there is this literature on risk rationing in the agricultural finance space, which is the idea that there are productive investments out there that in the absence of bundled insurance may not take place. And so this relates to that literature a little bit. So just talking about take-up. So on the left, we have a strategy method. As I said, for each of the 160 people, we have 4 decisions for each of the contract in an incentivized way. And then we have the final decision on the right, which I'll focus on. The take-up rate for the take-up is basically, do they accept the contract, pay their deposit, receive the bicycle? So 70% of the people who offered the hybrid contract, that's the highest take-up, and very similar to the debt contract, so 69%. So there is still a strong preference for very standard debt contracts, right? But there's also a high take-up of the hybrid. The take-up for the equity, the one where they could end up sharing a large amount, or a very small amount, is lower, it's at 53%, and the take-up for the insurance contract or the index contract is the lowest at 45%. We also check for adverse selection in terms of initial take-up. We do not find evidence of adverse selection in the sense that the most profitable individuals at baseline are not less likely to select into performance contingent contracts. We do find evidence that the most loss-averse individuals and the most risk-averse individuals, as measured by behavioral games, do have the highest selection into equity contracts compared to debt contracts. So no evidence from our take-up or adverse selection, some evidence that risk-averse and loss-averse people do select into equity contracts. Okay, so the estimation is pretty straightforward. We take for our main outcome variable, which is based on daily administrative data from the large firm, we aggregate that to the monthly level. As I said, we have daily data on purchases by the micro distributors. We then know how much they're selling to the end customer, very similar to the presentation yesterday. They knew how much the final product was being sold. All the chewing gum is sold at the same price, and so we can estimate some measure of gross profit. And that's the measure that we used when we look at calculating the performance contingent contract. It's a simple ANCOVA analysis where we control for baseline variables. Results also go through with the randomization inference. We also supplement the daily data with some survey data just to help us understand a little bit about mechanisms. So beginning with column 1 of results, here I'm pulling the 2 performance contingent contracts. All the numbers are in US dollars. And so this is looking at the equity and the hybrid. Profits increased by $26 per month compared to a control mean of $11 per month, quite a large amount. So the numbers on debt and insurance are actually also large compared to the mean, although we can't say anything in terms of statistical significance at conventional levels. When we split out the performance contingent into hybrid and equity, we see that the largest amount is coming from the hybrid contract. Remember that this is the one where if you work a lot, you end up owning the asset very quickly, but you end up paying the same notional amount as the debt contract, whereas the equity is the one where you could pay a lot or a little. And so the biggest effect is coming from the hybrid contract, also significant effect on the equity contract, and these are large amounts, $34 per month compared to baseline of 11. So column 3 looks at whether they are doing any sort of selling activity. So you may have in mind a possibility that once you offer performance contingent financing, they say, thank you very much, we're no longer going to sell anything, right? And so we do not see any evidence that people who offered performance contingent contracts are actually at the extensive margin not less likely to become sellers of any sort. And thinking more about the intensive margin, which is what is the proportion of the portfolio in which of the selling portfolio that contains chewing gum, the product that we see. At baseline, it's about 50% chewing gum, 50% other stuff. And this is measuring whether there's an impact of the treatments on the proportion of things, a portion of your portfolio that is the chewing gum, right? And so you may have in mind, you offer performance contingent financing, and then suddenly they stop selling chewing gum, or they sell a less amount of chewing gum. We don't find that. We find actually that they sell more chewing gum relative to the debt group, right? So this is consistent with our other story of crowding in on the product that is being taxed. We also check for spillovers. So why do we check for spillovers? When I mentioned the structure of this route to market program, you have this large multinational firm, and then there are around 200 stock points, which are small warehouses. Around 70 of them are in our project. Each of these stock points has around 5, 6, 7, about 6 people on average who are buying stock from this stock point, buying chewing gum, buying other things, and going out and selling it. A smaller number are part of our experiment, right? In our experiment, we're offering people bicycles. Now, it could be that our result is just driven by the fact that you give some people bicycles, they just steal the business of everybody else around them who doesn't have a bicycle, right? So that's absolutely plausible. And we're expecting some sort of negative spillovers, and we actually find evidence of positive spillovers. So this is a regression at the stock point level, controlling for the number of participants at any given stock point, and then the number that are assigned is randomly varied. And so we find evidence of positive spillovers. If you are not part of our experiment, if you are one of the 1,700 people who are not part of our experiment, having somebody who is part of our experiment offered a bicycle leads to higher sales for you. Not very intuitive, it definitely was surprising to us. But then when we looked at the tracker data, the GPS trackers that we put on the bicycles, it made a little bit more sense. I mean, people are moving around. We were working across all of Kenya, and people are moving around a lot, right? And so this idea is that you give people, some people bicycles, and they're actually expanding the markets in which they sell, right? And that can help you explain why there could be positive spillovers for the people who are left behind and still selling on foot, because you've left a little bit of pie for them by selling to further markets. This is also consistent with survey data, where we simply ask people what proportion of your sales is for customers who are far away, and we assign positive coefficients suggesting that once you offer people bicycles, they're more likely to sell to customers who are further away, which is consistent with the story of leaving a little bit more of the pie for people who are still there. We also find some evidence of positive effects, especially for the hybrid contract. People are more likely to visit the stock point to top up their stock. Their profits are less concentrated in any one given month, a little bit less likely to, more likely to sell a variety of products. And then column 5 looks at credit extension. So at baseline, the control group only extend credit to 8% of their customers. So as I said before, these are people who are themselves kind of like credit and liquidity constrained, and they extend very little trade credit to their own customers, right? And even in the case where they do it for a very short time, like a couple of days max, maybe, as suggested in our data. So individuals who are assigned to the hybrid contract actually extended a lot more credit to their own customers. So there's some measure of risk-taking themselves when you provide them a contract, which itself explicitly contains some element of risk sharing. We also find some evidence of greater business management practices using a standard set of questions about business management practices, especially for individuals assigned to the hybrid and the insurance contract, which are actually like the intellectually most taxing contracts, because the hybrid contract is one where you have to remember how much you've paid, and you keep a record of how much you've paid, and once you've paid a cumulative amount, the same as the debt contract, your contract ends. Of course, the MFI is already monitoring that, but it's good for you to monitor how much you've paid cumulatively. And the index insurance contract is actually quite a complicated contract, because it's the average of everybody in your region other than you, right? So, so we find some improvement in business management practice for individuals assigned to that. We also find that individuals in the hybrid contract are more likely to use their asset for business at the extensive margin, and also in terms of the number of hours that they use it. So some of these mechanisms, both from the administrative data and from the survey data, suggestive of contracts that when you provide explicit risk sharing within the contract, embedded within the contract, there's some evidence that there's greater amount of risk taking by the micro distributor themselves. And then finally, just to end, a little bit of survey data looking at household level outcomes. So we looked at the performance of the micro distributors, which improved. Improvement of the micro distributors also means improvement of everybody else in the supply chain. They're selling more chewing gum. It also improves the sales of the small stock points, the warehouses who they buy chewing gum from, and it improves the performance of the large multinational firm. It isn't necessarily the case. As I said, there are 6 different chewing gum products, and they vary in terms of profit margin, but we've done the calculations, and everybody kind of benefits from this intervention. You give small-scale bicycles, the micro-distributors do better, the stock points are also making more sales, and the large firm is selling more of its product. Now we're looking at the household level using survey data. Are there any improvements at the household level for the households from which these micro-distributors come? We find some evidence that most of the contracts lead to greater household expenditure on food. The hybrid contract in particular has greater household expenditure on clothing, and relative to the debt contract, greater household expenditure on schooling. And the final 2 columns, we look at health-related outcomes. So whether people are likely to report that they have health problems because of their work. All the coefficients are negative, which mean that they would be less likely to report health problems. None are significant at all, but the coefficients are relatively large. And I guess it's not so surprising that people who are complaining about back problems, you give them an asset to transport their stock, and they potentially less likely to report health problems.
Mohammed, we have 1 minute left.
Perfect. I can actually... So we conduct a field experiment with a large multinational food company to help micro distributors in its supply chain to finance a productive asset, which is in this case a transportation asset. We find particularly large benefits to contract with performance contingent repayments. And we think this is exciting in terms of like contract design space for not just micro distributors, but also slightly larger firms, still small firms, but slightly larger than the micro distributors, using developments in financial technology, in monitoring, which widen the space of potential contracts that you offer. And we're not saying that all MFIs should suddenly start offering performance contingent contracts. It's more a case of perhaps some microfinance institutions, some institutions that offer small-scale financing could expand the suite of products that they offer to some of their borrowers, especially graduated borrowers, to include contracts that provide explicit form of risk sharing through performance contingent contracts. Thank you for your time.
Thank you very much. The paper will be discussed by Giorgia Barboni, who joins us online.
Yes. Can everyone see my screen? Yes, hopefully, yes. Let me.
Georgia, do you want me to move your slides? I can do that if you want.
No. I have full control, I guess.
Oh,
That's
okay.
what I've been, right?
Perfect.
And can you guys see if I am switching one slide from another?
I think I can see data, unless I'm going mad.
So that's a person. Wait. Desktop 2. Is
Now
everything
I can see a slide, yeah.
Okay, cool. Okay, so I have 10 minutes, right?
Yes, exactly.
Okay, perfect. So thank you so much to the organizers for inviting me. I'm really happy to be able to discuss Mohammed's paper, and I'm really sorry for not being there, and also enjoying the stroll around Rabat in the afternoon. I'm Giorgia Barboni, I'm from University of Warwick, and Mohammed did a fantastic job in summarizing such a dense paper in 30 minutes. Something that I wanted to say is that I have already seen this paper in the past at a more nascent stage. I'm really happy to see it way more developed and with results that I can comment. So what the authors ask with this paper is whether performance contingent microfinance contracts work in developing countries. To answer this question, they have set up a randomized control trial with micro distributors of chewing gums in Kenya. What this RCT entailed was the provision of a business asset in the form of a bicycle. And then these micro distributors were randomized to receive one across 4 different types of contracts: a debt contract, an equity-like contract, which essentially helped borrowers to be insured against downside risk because the repayments were reduced during periods when there was lower profits, hybrid contract, and an index insurance contract. What do the authors find? Well, they find that the performance contingent contract, so the equity and the hybrid, increase profits and lead to also an increase in household consumption. How do they motivate these results? They have also a theoretical model that I'm not going to comment in these 10 minutes, but essentially the performance contingent contracts appear to crowd in on contract effort. So I have 7.5 minutes. Of course, this is an RCT. Results are already there. Data have been collected. The pre-analysis plan was already submitted. So what I can tell you, Mohammed, and your co-authors is basically a bunch of comments that are essentially related to the interpretation of the results, but also on the motivation. So when I started to read the paper, which is extremely well written, one thing that I basically began with was thinking about this concept of microequity, which in the broad microfinance literature is associated, of course, with the venture capital type of finance. And we know that this type of products are mostly active in very opaque informational setting. So we have this relationship between our entrepreneurs and the bank, the equity provider, in this case, a microfinance institution. However, there's very little observability in terms of what are the business relations of these micro-entrepreneurs, what are their outcomes. And in this context, based on Finance 101 that I'm also teaching my students, providing debt is very, very risky for the bank. What we have in this setting is, however, something slightly different, because there's a third player in this broad setting that is represented by a large multinational company, which is very active. And I guess it's also well established in terms of reputation in Kenya, and also well known by the microfinance institution. So the first question here that I have, and that I would like the authors to kind of explain it better, is to what extent debt-like type of contracts may not be suitable, or to what extent the bank would be incentivized to move out of debt contracts, having like a third party within this setting that can somehow guarantee even for these micro-entrepreneurs. So that's kind of my first question. The second question is more about the role of this type of microequity contracts, which, I mean, for those of us who are working in this specific segment of the literature, we are very interested in understanding any contract that moves out from that contract, because these are contracts that, again, in informationally opaque type of setting, can help borrowers grow more. So the other question that I have by reading this paper is, can the authors say more about what the growth prospects of these micro-entrepreneurs are beyond inventory? should we think of these entrepreneurs, which they are essentially right now some sales agents working for food co? Can we think of them as as entrepreneurs with high marginal returns of capital? And I'm thinking of this as to relate to the contribution that this paper is making to the limitations of that type of contracts. Can we think of these borrowers also transition at some point into some larger scale type of business? I don't know, like becoming the managers of the stock points in the setting. And the third point is, now it's clear more from also from the presentation that Mohammed did. So it seems like the MFI doesn't have an incentive, it doesn't have a stake in the contract itself, but they might still have some incentive to foster entrepreneurship for their borrowers. And I'm thinking also about some sort of equity-like type of student loans. So having said that, and going back to this role played by this multinational company, Food Co, one question that goes back is to the fact that outputs observability is a key implementation issue, typically in this microequity contract, and moral hazard may play a big role. And this is why you guys have amazingly done the first experiment on this. However, there's also the fact that potentially these micro-entrepreneurs have little incentive to deviate from their optimal effort, precisely because of the role of Food Co in their business. It's some sort of quasi-monopolistic role that these company play. So in some sense, the extent to which effort could be crowded out in your setting could be minimal. And this is good, of course. What I'm trying to say is that possibly what you're analyzing is some sort of the best scenario, and others will follow to try to release and relax some of the limitation. Not even limitation, but some of those aspects that you have so nicely set up in your RCT. But basically what I'm trying to say here is that the presence of Food Co may itself encourage a good behavior, and the contingent contract could be used by borrowers to signal, to show that they are good. So it's not only about product and profitability that increases, just that they kind of commit that for the time being in which they are transmitted to the microfinance institution, then they want to see that they want Food Co to see how good they are. So this is one thing to think about. I'd like also to have and to see more discussion about how profit measures were recorded by Food Co and transmitted to the MFI. And then another thing about outcome measures that came to my mind by looking at it is if any of the profits could be increasing profits that you find as impacts for your intervention, come, for instance, from discounts that Food Co apply. That you already mentioned that there is some discounts, but I wonder whether there were like these increase in businesses because these borrowers managed to go, these entrepreneurs managed to go very far away, and hence they benefited from that. In terms of analysis, I don't have many comments per se. Just beware about the power issues sometimes, even in the balancing checks. One thing that I, however, want to mention here is whether it might be interesting, for instance, to look at the differences, if there are any, of profits within the time frame of your intervention in the first 12 months in which the contracts hold and after. If you don't find differences, or if you find that sales increase even further, then it means that they weren't trying to show off to some extent while they were under close observation by the MFI and potentially under Food Co as well. In the last 30 seconds that are left, I just want to kind of mention one thing that Mohammed also hinted at the end of his presentation, that is this intervention is fantastic, but it also entailed an enormous coordination effort to implement a set of contracts with the local MFI, plus getting data from a third party, which may be very difficult in other settings. So I guess that in terms of scalability and policy implication, one natural question is how scalable would this model be absent the research team managing several aspects of the intervention? Because I suspect that you guys did a lot of work behind the scenes. And just to conclude, this paper essentially succeeded where most of us did not, yet at least. That is setting up an intervention to test whether contingent repayment contracts can improve business outcomes, and this is amazing. I would like to see more discussion on how this setting is suitable to identify high potential micro-entrepreneurs. What is the generalizability of results absent these strong trade relationships with the multinational company, which somehow could be even used as a collateral for a debt contract for these micro-entrepreneurs. And I think that the last point that I have, particularly for the motivation and introduction of the paper, is that, I mean, one suggestion is that you guys may also want to tailor this paper more on the role of microfinance, broadly intended, so to include also contingent repayment contract to smooth supply chain frictions. And that's all what I wanted to present. Thank you so much. This was an amazing paper.
Okay. Thank you very much, Georgia. It's amazing that you can give me such insightful comments, having already seen the paper and given me comments before. So I really thank you for that. These are great points. Quickly, I'll try and address some of them. In terms of like thinking about, are these high marginal return to capital people and growth prospects? What do like the most successful micro distributors look like in our setting? And you've said some of those things already. Actually, some of them, not in our particular experiment, but just looking at the broader program and the data that we have for the broader program. Many of them do actually transition to owning their own stock points, so owning their own small warehouses. So they do move up the supply chain within the large multinationals kind of supply chain. So some of them do that, although we can't really tell based on the relatively short term of our data whether that happens with anyone in our experiment. But that's what happens for many, for some of these people who are super successful, and the others who are super successful end up buying much more sophisticated transportation assets. And when we were in the field and we told people that we were starting a project to finance bicycles, many people said, okay, that's great, but we need a motorcycle or we need a car. And we said, oh, we can't fund a motorcycle or a car, right? But many people did want that. And just anecdotally, there were people who I met people with cars full of chewing gum, which is just a bizarre thing to see. But that is what the most successful distributors look like. They have very kind of like sophisticated kind of transportation methods. How the profit, in terms of the sample size here, I mean, yeah, it's a fair point, and we try to be very careful in terms of not doing any heterogeneity analysis, really, not doing too much heterogeneity analysis in terms of looking at follow-up outcomes, given the small sample size. I mean, we probably would have liked to have a larger sample size in this, but given towards the end of the project, COVID happened, etc. So we were limited there. We can start looking at dynamic effects up until COVID-19. So that's a good point. And there's a really nice point that you make, that actually can address one of your other points about whether they are just doing something to show off to the large multinational during the period of the contract. We could look at dynamic effects to see whether that's the case. And this relates nicely to your final point about scalability. I feel like I shouldn't be admitting this in front of an audience of my peers and policymakers. Clearly, like, there are limits to how much we can generalize from this setting, because like part of the effects that we're finding are the fact that we're within the supply chain of a large multinational corporation. Those micro distributors want to be part of the food co's program. They want to move up in the supply chain and food co's program. Many of them probably would want like a fixed wage job from food co's supply chain, and so that is probably like a big part of our results, right? And especially when you look at the conceptual framework that we use and the fact that we don't see any sort of like side selling or moving away from the on-contract thing. I mean, that's very likely related to the point that you mentioned, that it's a great program to be part of and people want to be part of such a program. And of course, admitting that limits the generalizability of our study, but I do think that there are many route to market programs where there are interesting similar things that can be done to help people with a productive asset within the supply chain, especially for micro distributors. And so I think it limits generalizability in terms of either small finance, microfinance settings, in which case, we need more work from people to try out in different settings, as you are doing and as others are doing. But we still think that within the setting of supply chains and large multinationals, there is something to be done, and there are a growing number of multinationals going in low and middle income countries to sell consumer good products. But thank you very much, Georgia. These are really, really useful comments and lots for us to reflect on.
Thank you very much, Mohamed and Georgia. Now we will move to the floor if there are any questions. There is the lady in the front.
I'll just speak. Oh yeah, there it is. Okay, question from the lady in the front. Very nice talk, thank you. I really enjoyed it. So I had just one question. I was quibbling a bit with whether the high take-up of the hybrid contract can tell us something about the underlying structure of the risk. So if you think this is an environment where I just don't know the long-run payoff of the bicycle, then you think like equity is the way to go. But if it's like that I know over the next 6 months my profits will go up X%, but there's some IID shocks around that I, because I'm liquidity constrained, I can't insure against, and maybe that could be a reason why the hybrid one is more useful. And so that could tell us whether it's really persistent versus kind of transitory risk that people are worried about.
Yeah, that's a really interesting point, Alessandra, for thinking about it. So your point is that for certain types of investment, maybe someone would have a feeling that this is going to pay off, but I'm just not sure when it's going to pay off. Is it going to take a while to pay off? Whereas other types of investment, it could actually just not go well at all, right? And different types of contracts can help in certain settings, right? That's an interesting one. Yeah, you're right that definitely if it's a type of contract where I think there's a non-trivial risk of it completely not going well, then the equity would be more suitable, whereas the hybrid has more of an intertemporal kind of feel to it, right? And perhaps we can do more in terms of the conceptual framework, in terms of speaking to that, because at the moment we're completely abstracting from like intertemporal smoothing element of the hybrid contract, which is potentially an interesting thing. And we also have kept it kind of like neoclassical in a way, haven't gone behavioral, but there could be like some behavioral sort of thing going on with the hybrid contract in the sense that if you have an endowment effect, you may want to exert effort quicker to own the asset quicker. But these are interesting points. Thank you. Definitely something for us to think about.
It's more profitable, but at the end I end up distributing gum because these guys are nice and they gave me a bike.
Thank you, Gianmarco. On the question of whether these guys are nice because they gave me a bike, I think that's less likely because it was the MFI that basically financed the bicycle, so it wasn't necessarily the multinational. Of course, they could still perceive that to be okay. You basically allowed them to do that, right? And that's why I'm kind of doing well. I'll think about that. On your first question, what's the other suppliers that are competing here? There's another chewing gum company that has a program, and so we don't have any data for whether they are actually selling any of that. I mean, we just have survey data, which is their total sales, and then we observe the portion that's from Foodco. I can think a bit more about that. But in our particular setting, it's just what they were mostly selling was basically either this type of chewing gum or the other type of chewing gum, or toiletries or drink type of items. So no cookies or bread companies that we think were directly competing in this particular setting. But it's an interesting point about whether you could actually get this competing over these suppliers. Thank you.
Great paper, Mohammed. To what extent, on scaling, to what extent has the microfinance institutionalized the product in their own offering? So are they continuing to offer this product with that? Are they taking up more? Are they offering other performance-based contracts on productive assets? Have they stopped doing it? Where are they at?
Yeah, it's an interesting question because often these types of studies where people have taken like a conventional microcredit product and amended it to make it, say, more flexible, to add certain components. Often there's a question at the end, which is, okay, did the institution adopt the product later in its own portfolio? And my sense, maybe Georgia can correct me, is my sense is that many do not. And so there's an interesting question about why they do not. I've got kind of like a simple response in this case, which is they can't because they don't have the data from the multinational. And the project ended and they didn't have access to the data, right? Which actually nicely links back to one point that Georgia made that I didn't address, which is the scalability thing, right? So this was something whereby we had an agreement during the duration of the product that the data would be shared from the multinational to the microfinance institution. So as soon as the project ended, there was no more data sharing, and they couldn't actually implement performance contingent contracts with this group because that data was cut off, and it speaks to the point that Georgia made about scalability. But just one more thing to add on the scalability, like if we were going to do this again, yes, it's true. As with this project and many other projects, the reality is that the researchers have a lot of control over the implementation of a project when it comes to a small-scale project, and you lose that control when you scale up. But I don't, having seen the results that we have in our paper, I think if we were going to scale up, there's no way I would implement the index contract. It wasn't successful. I didn't speak about it in the paper, but there's a lot of basis risk that we found from our index product, and people just didn't really like it as much, right? So I would definitely drop that product from the suite of products, and there is potentially even an argument of dropping the fixed duration equity contract and just going with the more hybrid contract. And so I think if I was going to scale it up, I'd probably reduce the number of contracts, definitely dropping the index one.
So yeah, maybe I missed it, but did you show impacts on repayment rates? And is the repayment amount subtracted from the profit amount results? Because especially for the debt only, it seems like there is no significant impact on profit. So are they buying like a negative return for them, or is it just lack of power? So yeah, and also the timing of repayment, if you have data on that.
Yeah, so I didn't talk about it. I mean, our repayment period. So we had non-repayment across the contracts, and towards the end of the project, the MFI was not actually able to do anything about it because COVID hit, and so they weren't able to go and collect or repossess. But there was non-repayment even before COVID, and the highest repayment rates were actually for the equity and the hybrid contract, which is consistent with the highest profits. And so the repayment rates for those are significantly higher than the repayment rates for the debt contract. It's true that the coefficient size on the debt contract, the coefficient on the debt contract is not statistically significant, but the magnitude was relatively large at $10 per month. And so even though non-repayment on average was probably like $50 over the contract duration for the debt contract, the suggested improvement in profits is greater than that non-repayment. So if you were to do like overall kind of like internal rate of return analysis, cost-benefit analysis, the program is still very beneficial overall, even if you just look at the overall increase in the profits of the entrepreneurs, micro distributors, versus the cost of the program in terms of the lost amount on the loans. If you then even added the the multinationals extra sales and the stock points extra sales, overall it's a very kind of profitable intervention. But there was some non-repayment.
Okay, thank you very much.
Thank you.
We are on time. That's perfect. I think without further ado, we are going to move to the policy panel.
Ah oui, d'accord, d'accord.
Alors, il y en a pas eu ce matin. Mais
D'accord,
au cas où,
ok,
vous avez
ok,
sur la
on peut mettre
discussion,
ça
je vous
à
mets
côté,
ici,
ouais,
vous
ouais,
mettez
ouais.
ça.
Moi j'ai mon propre 1, 2, 3, 4. Donc. Okay, so welcome to the policy panel at the end of this conference. So please have a seat. So I think as Kenza mentioned in the introduction, one of the nice things about this conference is we talk about things that are very related to research, but also things that have policy implications, things that touch on micro, on kind of experimental design, but also things that touch about the macro environment. So the idea will be to bring some policymakers and practitioners at the end of this conference to kind of wrap up the full thing. So I will introduce you to the panelists. So you have on my right, you have Sarah Bertin. So Sarah Bertin is based in Rabat. She's a chief economist for Morocco for the African Development Banks. Before she was the chief economist in Egypt, in Cairo, and for some time also the active chief economist for the regions. On the right of, I never know what's my right and left. I think I'm right. So on the right of Sarah, you have Deborah Revoltella, who is based in Luxembourg. Deborah is the director of the economics department at the European Investment Banks. She has played this role of a chief economist for about 10 years now. And as you know, the European Investment Bank is involved way beyond the border of the European Unions. They lend 10% of their portfolio outside Europe, and given the extremely large portfolio they have, it corresponds to big investment, and they are trying to do some economic evaluation of their programs, of their impact, as well as to understanding the global environment and design the strategy. So on the right of Deborah, you have Taoufik Lahak, which is a Deputy General Director of Time Will Come. And you have heard of Time Will Come a lot this morning because the paper that Kenza presented were based on their loan guaranteed program. But I will come do much more than just the loan guarantee programs. They also have a program in which they invest equity, and Taoufik will tell us a bit more how these various large-scale programs contribute to small business development in general, and growth in Morocco. And then finally, on my left this time, I have Harry Devonshire from the Argidius Foundations, and the Argidius Foundation is a private charitable foundation based in Switzerland, whose objective is to improve the effectiveness of the small and medium enterprise through development services, business development, access to finance, and some of the programs that were discussed in this conference in Uganda receive support. I think I'm right, no, from Argelius. I hope I'm right. I am right.
Looking at the researchers.
So I thought that from Vittorio, I heard that Argelius was involved. You can confirm it. Okay, so I hope I was fine. Okay, so I think that was a bit of the presentation. So what do we want to learn from this panel? So first, of course, we want to learn from your respective experience. We want to know your own perspective of on what has been discussed during this conference. What did you learn from the workshop? And then how do you see the future of policies supporting small business development and growth? And maybe, I believe the conference was quite extensive, but you might identify some gaps in the research. What type of question do you think deserve more research beyond what's done and what's been presenting at this conference? So I think the rules of the panel is that I will ask each of the panelists to do a first intervention about 8-10 minutes, no more than that. Then I might ask 1 or 2 more questions, and then we're going to open to the floor. So maybe we can proceed in the same orders of presentation. So Sarah, do you want to go first? Yes.
Yeah. Thank you very much. I have a brief presentation. I don't see it. Okay, thank you. And where is the things to... Oh, okay. So thank you very much for inviting me. The topic raised during this conference were focusing on low-income countries. However, Morocco is a middle-income country, but a lot of the topic do apply to the country. So I'm going to try to be brief and understand why don't we see anything. Okay. First of all, the country faces issues that are that were talked about a lot here, which is participation to the labor market in general. So we have a trending down rate of unemployment. I put the data from 2019 because obviously in 20 and 21 it was up a bit. But especially the two issues that are very striking in the context of Morocco, and not only Morocco, it applies to the MENA region. We had the same issue in Egypt as well, where I was based before, is that you have a very low participation of youth to the labor market with a staggering rate of unemployment, and you have an astonishing low participation of women to the labor market. And those two things, because it's a middle-income country, is independent of education. It's not because you are less educated that you participate less to the labor market. Even so, for women, educated women have a tendency to participate less than less educated women. So there is really an issue of participation to the labor market for youth and for women. There is a need, I'm going to go to the going forward later. As I was mentioned later during the presentation, the African Development Bank is in charge of a trust fund financed by the Danes, which is called EINA for Jobs, and who looks at small business development, entrepreneurship, and job creation in the region. Last year, they did some very interesting simulation on Egypt, Morocco, and Tunisia, and the amount of jobs that needs to be created by 2030 to absorb new entrants into the labor market, but also if we were to aim to shrink the unemployment rate by 2. It's 8.4 million with a constant unemployment rate in the region, is 14.5 million if you want to halve the unemployment rate. And in the case of Morocco, those data are 1.9 and 3.1. Just to give you a comparative for low-income country in general, but even developed country, the number of new entrants per year in Egypt is, the number of new entrants in the labor market per year in Egypt is 800,000. young people. So the need to create jobs are just enormous. Morocco has been performing fairly well out of the last 2 decades, okay? It's now a middle-income country. It has an entire, like 2 decades ago, it started to attract FDI. We'll talk a little bit about it in a second. And its growth rate is decent. You know, it's between 3 and 4%, give and take, on average. However, it's trending down. Since 2012, despite massive public investment, it's trending down. And there is a new development model. A new model of development, and will not go into the detail because I only have 10 minutes, but it aims for a double of GDP per capita at the horizon 2035. That implies a growth rate of 7%, okay? So if you want to reach that growth rate, there is only one option, and it's small businesses. Why? I will go into it in a second. The development of ecosystem with major FDI sustained growth, but did not create that many jobs. In fact, if you think of the jobs that were destroyed by the accord multifibre, I don't know in English, the multifiber, l'accord multifibre de 2005, they were not compensated by the job creation in the automotive, in the pharmaceutical, and in the aeronautic industry. So that import of big companies in ecosystem around the automotive, the aeronautics, the pharmaceutical, have not been creating enough jobs to absorb. So smaller and medium enterprises concentrate 2/3 of the job creation, okay? But they contribute only 36% of GDP. And 81% are informal, 15% of bank credit only are allocated to small and medium enterprises. About bank credit, and I think it's an important point given the discussion that we had during the last day and a half, is that last year we published a report with EIB and EBRD, and in that report we analyzed the access to financing of small and medium enterprises or of the private sector in general. And in fact, they don't go to banks because they think they're too costly, because they think they won't get a loan, and because they think they don't have an interlocutor that can understand their business model. So I think it's something that take into account that de facto they don't go for banking credit. I'm sure you will be able to confirm those data. Moreover, we see in the context of Morocco, and part of it is linked to the importance of the agricultural sector and the impact of climatic condition on GDP, but also we see that small and medium enterprises are more vulnerable to shock. External shock or shock in rural income or shock in the tourist industry, as we've seen during COVID, they are the most hit. So the same, in 2000 and 2021, 43% of those small and medium enterprises experience a decline in activity. Moreover, we know, and that was the work of the IENA platform as well, that jobs, the nature of jobs is changing. There is less and less probability in a middle-income country like Morocco that you will gain a full-time contract in a company somewhere. There is more probability that you will be self-employed, and I'm referring to Alessandra's paper, self-employed in a productive cluster, let's call it this way, where you will be linked to a company but not with a full-time contract. So taking into account those two things, I also think that slide is important, is we did last year with the Bureau of International Labor a survey of small and medium enterprises, and which constraints they did identify and which needs they had for technical assistance. And I think the table the graph is fairly straightforward. I'm going to translate sorry, it's in French. I'm going to briefly translate in English. The first thing is their commercial strategy. They feel they don't know how to do it. The treasury planification is the second. How do you plan and manage your cash within the company? The knowledge of the market is the third one. And the 39% refer to the lack of credit. I can send the slide if you are interested after Kenza. The third one refers to the lack of banking financing. They don't know how to approach a demand for financing. Then you have what is their product? How do they position themselves within an industry? Like what is their product? What is their service? What they exactly do? The planification of activity over a year. What I find interesting is the fiscal constraint doesn't appear at the top, which I'm sure if you were going to ask the same question to French small and medium enterprises, the fiscal constraint will be at the top. So I found that kind of interesting. Then the latest one are less striking. But I think the top five are clear indication of why those companies are not growing and expanding. One thing which is very important is there is plenty of programs, and I think that's why what you guys are doing at the research level could be very, very important for the programs that are designed to support small and medium-sized businesses. The work done by the platform, the ENI platform, mentions that those programs are facing three issues. The first one is that it's not big enough. We call that scalability, but it's not big enough given the constraints and the needs that are arriving to create more jobs. So it's too small. The second one is how are they financed? You need to find more ways to finance those programs. And the third one, and I think that's where the research community can really have an impact, is the selectivity. How do you choose people, and how do you evaluate those programs? Because the selectivity will be extremely important to ensure the success of these programs. All the work of the ENA platform, and the reason for which I'm putting that out, is we shouldn't believe that those concerns are not at the top of the agenda of the Moroccan authority or of the Egyptian authority as well. I do not work on Tunisia, but those two countries I worked on, it's really at the top of the agenda of the government to create jobs and dynamize small businesses. There was a very high-level conference in Rabat in early June, and in fact, the government of Morocco and Tunisia signed a policy manifesto. You have the 7 operational innovation of the policy manifesto. I will be more than happy to share the slide. I only have 10 minutes, so I'm not going to go into the detail of it. But once... Sorry, it's not me. I didn't touch anything. Once again, one thing that was really important that I mentioned here is the need for monitoring and evaluation system of those programs, and which component of those programs proved to be the most efficient in creating jobs in the context of small and medium enterprises. The government, the AFDB is doing something truly interesting now. We don't have the full result, and it's done with the Ministry of Finance, so they will be presented by the Ministry of Finance. But we are conducting a survey of profile of entrepreneur across the 12 regions of Morocco, because there is a tremendous regional disparities and constraints are not the same over the 12 regions. So that survey is going to come out. The government is working on an investment order and small business act, which will embody some of the results of that survey. Then there is an entire thinking about the development of small and medium businesses. I will leave the point on the funding to the next panel speaker, because if not, we are going to be redundant. 2 more minutes, I think I'm on time. I just want to mention a few things that could be applied in the context of middle-income country and in the context of Morocco to rebound on the research that was presented. The first one that I found really interesting on the human capital and the difference between vocational training and infirm training. In the context of Morocco, as I explained, they developed an ecosystem, Peugeot arrived, there is training centers in those firms. Part of it is subsidized by the state. However, that doesn't trickle to the rest of the economy. It's not because you had a job there that you will have a job somewhere else and transmit your knowledge, okay? So I think that was interesting. There is a lot of formation professionnelle, vocational training here, but once again, it will be very interesting to know what is your future in the job force if you have been in those firm training or in the vocational training that exist. I have not seen any evaluation of the two systems and their impact on job creation and on your participation into the labor force over time. Childcare and the impact on women participation in Uganda. In the MENA region, it was mentioned during the presentation, social norm, okay, which I do believe are important. However, when we look at the participation of women in the MENA region, we don't have a precision of what is social norm. Can we have some research on slicing it down? Like, for example, in Egypt, they figure out that one of the impediments of women going to work was the safety of transportation. If you could afford transport to women where they were not going to be harassed in the bus or in the subway, they will be much more willing to work. I don't know if that accounts for a social norm or not, but I think the term social norm should be sliced down to really understand what is the main constraint in the region. Okay, so that's the second one. Self-employment within the firms appear to directly apply here, because we have small businesses. The door example I really, really like, and I think it's one of those things that the program, so small and medium business development push, which is peer-to-peer learning. So I think it will be really interesting also to have some evaluation of how it could be implemented in a middle-income country, and in the context maybe of Morocco, and what evaluation we can derive from that. Then the adoption diffusion of technology did not work in Morocco, as I mentioned. You have those big ecosystems, it doesn't trickle down, it's very little Moroccan added value, inputs, you change, you export. We pointed that out in the report we did with the IB. So it didn't work. We talked about initial condition. When you look at the level of human capital in Morocco, which there is still a fair amount of issue about that, but when you look at the level of capital, it increased drastically since the 80s. Okay, if you talk illiteracy rate, primary school, secondary school, it's staggering what has been achieved by the country. It doesn't mean there is not issue with equality and labor productivity and human capital right now, but the progress has been really impressive. However, maybe there is a story of initial condition in the context of Morocco. So now you have 100%, like 100% of the kids in age to go to primary school, boys and girls. But in the 80s, it wasn't the same ratio. It was much, much lower. So maybe it hasn't worked until now, but it will work in the future. And I think we always point out South Korea and why it did work and why in Asian country it did work. I think it will be very interesting to look at papers that do the opposite, why it didn't work. What make it not working in the context of Morocco, of other country? What are, you know, the constraints, like doing a diagnosis that of what we've seen, that what are the explanatory factors in the context of South Korea and why we don't find them in those countries. I think it will be interesting. So last things I would like to say, and we have Moroccan counterparts here, is the example of Uganda is fascinating, because when a country makes its data available, it gets a lot of human capital inputs. So I think, you know, there is a direct benefit of data availability. There is a lot of data in Morocco. They are sometimes, at times, difficult to access. So I think, you know, there is that will be a very strong policy recommendation, as far as I'm concerned, that we can, as policymakers, have more fact-based policy advice, and based on your work as researcher, and I know to do that you need some data. So I hope they will be more available in the context of North African country and in the Median region. We had the same issue in Egypt. Thank you very much. I hope I didn't last more than 10 minutes.
You were perfectly on time. Thanks so much, Sarah. Deborah, you want to...
Thank you very much. And I also have a presentation. I hope it's coming up. There is no presentation? Okay. Okay. I start mentioning what I will do in my 10 minutes. In fact, when I saw the topic of, when I was invited and the topic of the panel, I immediately saw that was a perfect opportunity to discuss a report that we just published jointly, and I will show it, together with the European Investment Bank, the EBRD, and the World Bank. And it's a report that is based on a survey of some 6,000 firms, 5,800 firms in Egypt, Jordan, Lebanon, Morocco, Tunisia, West Bank, and Gaza. That's the enterprise survey, something that is run all over the world, and in this moment we actually decided to do a special run between 2018 and 2020 for the region, putting together the resources of the three institutions. But then what also we did was not only producing data, and data are available for every researchers, but also what we did was working together on a joint report. It's not often that it comes that three institutions like us put together brain of researchers from the economics department. And what we have is actually this short, small report that is, we call it the Chapeau report. And then there are 9 working papers that detail the various areas of analysis on the business environment in the region. So what I will do is, in 10 minutes, present 9 working papers plus the Chapeau report. So you imagine I will go very, very fast. But in fact, what I wanted to pass is the main message that we have. And the main message is that it's a complex environment for a private sector in the region. And that's actually, you have a number of constraining factors that come together and that limit the opportunity of private sector development. And wherever you come from, you have the challenging macroeconomic vulnerability coming out, particularly at the current moments coming out of COVID, with the new global shock coming after the war. You have a vulnerability on the macro point of view coming. Then if you look at the micro level and the business development, you see various aspects of vulnerability affecting, or structural vulnerability affecting the business sector. I will go through some of those messages, but actually what we see is that in the region, firms, even those engaged in trade, they have the benefit of engaging in trade. They also get some of the innovation benefit that you normally associate to participation in trade. But actually the upside in the region is not as large as what you would see in other comparison regions of the world, that actually we look at medium and low income countries, and particularly we also look at a group of countries in Central Eastern Europe that we have surveyed at the same time, and actually we have a parallel report on the region. Then we have another element that is managerial capacity and skills. Actually, we have been talking a lot about that, and we have been talking a lot in yesterday also as well as skills. What we see is that in the region, generally, you have a weaker managerial capacity, assessed through standard indicators of managerial capabilities. You also see some deterioration at the regional level, and you see a link between the public ownership and managerial capabilities. And also you see the effect on training with a low focus on training at the regional level. You see the competition from informalities that affects firms' growth. And you see another element on access to finance that I will detail a bit more later. But basically the conclusion we come to is that access to finance is not the binding constraint for firm growth. It may affect, but it's not the binding one. So actually what we find out is that we have a large share of voluntary autarkic firms, and these firms don't lose growth opportunity by voluntarily excluding themselves from the finance sector. So the scenario is, when we were writing the report, we said, but this is a lot of structural and crisis-related factor going against the private sector. But we wanted to close it with a positive tone, saying actually, then you know this, and there is a room for improvement. And actually, you find areas where actually areas and countries that are doing better and doing really address the constraints is something important to do, and really you know where the constraints are, and then it's the moment to tackle them to transform. So I start with this, and I start from the macro outlook. The macro outlook is somehow we come from the pandemic, we come from now the war with the effect that it's having on food and energy prices. Of course, there are differences in the region between energy importing and energy exporting countries. But at the end, this is putting additional pressure on the fiscal side with the request for compensating measures for vulnerable households and firms. But actually what we see is that the level of public debt has been increasing a lot. So at the end, we find ourselves in a situation in which you have pressure on the fiscal side, already high level of public debt, and we all know the global tightening situation, and still vulnerability coming in. So on the macro side, the pressures are there at the regional level, as we see pressures at the global level. But I think the point is really also this strong increase in public debt that on our assessment throughout the region, and I don't want to point to single countries, actually shows somehow the weight of the public sector, the crowding out of the private sector at various levels. I move to the second topic, that trade as a driver for innovations. This is a very nice paper, actually, that you can look in one of the working paper. Is looking at the trade performance of countries in the region versus peer countries. And actually, you see that, so we know from literature, we know also from the literature sure from other studies that international trades actually is a determinant of competitiveness, and it also affects the innovation capacity. And there is this nice translation from participation in trade to exploiting the innovation capacity at the firm's level. And we see somehow the same thing also in the MENA region, but at the end, if we look at the firms in the MENA region, the upside in terms of innovation is less than what we would see in a peer region. So the capacity of using trade participation as a driver for adoption of innovation actually is lower in the region versus other areas of the world. That's part of our story is again that the weak business environment limits a firm's ability to reap the scale and efficiency benefit from trade and innovation, but particularly on the innovation standpoint. I go to a second point, the managerial practice and skills. Managerial practice and skill matter. What we find in the study is actually we build an indicator of managerial capabilities, looking at the indicators for the monitoring, target setting, and incentive framework. What you see is that the region ranks lower compared to peers. There are differences among countries, but it ranks lower. And what we find in the study is also that there is some links between managerial capability and government ownership, with at least partly some effect of government ownership on the poor score in managerial capabilities. And then we look at providing formal training. And here we find something quite interesting, because we all know that return on training are much higher, more educated workers you have. So we think that this is, in the region, there is relatively little formal training compared to peers, and we think that that's a lost opportunity exactly because the working population is relatively educated, so you may have a much more upside in terms of applying training in terms of having returns. I go quickly to another topic, actually the one on competition from the informal sector. And here we have a question in the survey that asks firms if they fear competition from the informal sector. And we look at the firms that actually fear competition, and we see that they have a sizable growth effect compared to others. So in fact, it's affecting firms' growth. And that's also another element of the business environment, if you want, constraining the growth of the formal sector. We were talking about SME. I just put you some indication of how SME are performing in terms of trade participation, innovation, and offering training. And you see actually the effect is very different and lower compared to large firms. I wanted to go to the point of finance, and then I'm close to finishing. On finance, that's something I think that's probably the one element that in terms of policy action, one has to reflect the most. And the story that we develop here, and also the analysis running parallel in the region versus all Central Eastern Europe. So maybe it's interesting also to look at the comparison between the two. What we find is actually relatively low investment rates in the region, actually even at the macro point of view. And also we had a previous survey run 4 years before, and actually you see that actually the investment rate in the region were declining over time. Then if we ask firms what are the constraints to investment, you have a lot of firms that actually say that high interest rate discourage them to apply for the loans. And in fact, what you see is a very high share in the region of firms that are autarkic or voluntary autarkic. These firms are firms that don't have a bank account, don't want it. They say don't want it. There may be a reason why they don't want it, but actually they live without access to finance. And what is interesting is that even those that are voluntary autarkic, they don't grow slower than non-autarkic firms. So the concern that we have is that there is some effect related to access to finance, that the constraint is not the binding constraint for firms. So at the end, our message is that finance is not the binding constraint, so there may be something on unfavorable business environment behind. But I wanted to close with a positive tone. And in the positive tone, what I wanted to say, and that's coming out from all our analysis, is actually that countries are not all the same. And also in the region, you have areas of potential work in terms of upscaling and transforming the business environment. And that's where the various elements that we analyze, on the one side, the managerial, the training part, but also looking at the constraint of the business environment, working in this direction, it may be easy actually to unlock the potential. And once you unlock it, actually the growth prospect for the private sector in the region may be much stronger.
Thank you very much, Deborah. So, he's here. Yeah, sure. No, there is no problem. The program, the show will go on. Okay, so we're going to change a bit the order, and Harry will now take the floor for 10 minutes. Thank you.
So, thank you again to our hosts, the bank and everyone who supported it, and for all the fantastic research papers presented. So, as mentioned, so Argidius, very briefly, private foundation. It's part of Porticus, which is one of the large European private donors. And Argidius has worked on enterprise solutions to poverty since the 50s. In the 80s and 90s, we helped establish the microfinance industry, building the institutions, building the collective voice of the sector. When that became increasingly commercial, we sought new ways. And had one of the slight disappointments of the microfinance piece was that it hadn't generated the employment that we thought it would. We thought micro-entrepreneurs might develop into small businesses and medium-sized businesses. That trajectory doesn't seem to follow through. So the job challenge, we've heard it is the major challenge, especially for this continent. We know that salaried wage jobs are the distinguishing feature between the poor and the middle class. We also know that where do these jobs come from? Well, small businesses, as we've already heard much more articulately, are going to be the key creator going forward. We're particularly interested not in these micro businesses, but we're interested in small, medium enterprises and these are some segments that we find helpful. So formalizing businesses, think the top 2% of a microfinance portfolio, the individual clients who are taking on, who actually, they might have started out of necessity, but they demonstrate a good propensity. They've started taking on employees and they've got a growth ambition, or they've had that growth ambition ignited in them. The more dynamic businesses are things like agribusinesses, the millers earlier in the conference are a nice example there. And ventures, businesses that start with scale in mind. And we see these businesses at different stages, either in the very early stages in the idea, in the early stages when they're working out their business models, or in the more growth and expansion stages. So over the last 8 years, just getting to grips with this. over the last 8 years, we've pursued a strategy of finding out how are entrepreneurs best supported to grow their businesses and generate employment. So we've sown 1,000 seeds to see which flowers bloom, as the expression goes. We've worked across all of these stages and these scale potentials. We've tested a whole range of interventions, from business accelerators, consulting programs, business networks, access to finance, whether that's new early stage funds or whether that's helping commercial banks develop effective SME strategies and products. And we've tested these out. And we've monitored, both within our portfolio, we've asking this question, what works best? We've supported and required our partners to collect data on the businesses they support, year-on-year data. We ask for at least 4 years of data on any firm supported. We ask for that data over time, and we monitor and assess it. We look at that against the total cost of the intervention to try and identify value for money. Where's a job created most efficiently? Where's additional revenue generated most efficiently? And maybe the reason I didn't know which projects we fund here is we're particularly interested in what others are learning. There's a huge amount going on in the academic community. There's also a lot going on in other funders' portfolios, and so we regularly share what others are learning. And what we see is fascinating, because I think one of our theories going in is, we work in development, we're looking for a silver bullet. Is it venture accelerators, or is it debt for formalizing businesses, or networking for dynamic businesses? And what we found were effective programs and organizations, those which you put in $1 and you get multiples, anywhere between 4, 5, 6, up to over 100. There are green dots. We were getting strong impacts. We also had the reds, what Graham Macmillan at the Visa Foundation called the wows. Why, oh, why did you do that? Or why, oh, why do we do that? And interestingly, sometimes those were actually programs run by the same organization that got a higher score, and then those in the middle that we labeled could do better. This pattern of mixed results, some programs being highly effective, some being much less so, was repeated in other funders' databases and across research and learning initiatives. So here some of the key literature showing what can sometimes look like pretty similar interventions, business training, and getting wildly different results. Same with mentoring, same with microfinance. We see that extending it, not so effective, focused and targeted at those entrepreneurs who are best able to absorb it, can be very effective. So what is it that makes the difference? What we find is it's not what you do. It doesn't matter whether you're an accelerator, a finance provider, or a business network. What matters is how you do it. And we've heard some of these characteristics from others' research. So the first one being selectivity. One-size-fits-all policies don't work nearly as effectively as a basket of approaches that are specific on the profiles of both the enterprise and the entrepreneur being targeted, and that have a good matching of what they need to that profile. And entrepreneurs' needs and problems and the challenges they face are very dynamic. So I'm going to jump to the A, addressing problems. The most effective interventions are responsive to the problems that that entrepreneur is facing. They help the entrepreneur identify their constraint or opportunity and respond to that, and if necessary, learn how to avoid it going forward. The much less effective interventions will teach entrepreneurs what they ought to know. So we think entrepreneurs ought to manage their finances. Now we think they might ought to digitize. But if that's not the pressing constraint they're facing, that knowledge is not going to stick. So you have to find out. So there's all sorts of programs, whether it's flipping the curriculum in a classroom, so you're not teaching, but you're finding out what those problems are and allowing peer problem solving, and then the curriculum for those for whom the problem applies. Whether it's business tools that enable them to get out in the market and find out what it is that customers want, like Lean Startup and Business Model Canvas, some interesting trials there. Or whether it's through peers, peers who have faced similar experiences, or whether it's through consultants or mentors who can understand the problem and where they're at and help them analyze and move forward. Charging can be a very effective mechanism to help this selection piece. So, we encounter this piece in the development sphere where either there's sort of two ideologies. Either small enterprise development should be commercially self-sustaining. This is a market that's not working, we just need to tweak it and it will just work. Or those who think entrepreneurs can't afford or are not willing to pay anything. We find the truth lies betwixt the two, and the best results lie betwixt the two, and you have to find out where that measure is depending on the intervention and the enterprises that you're working with. And even micro-entrepreneurs, when tested, will have a propensity and willingness to pay. And when they do pay something, the engagement, the attendance, and their performance improves. But nowhere do we see, except in some very sort of extreme exceptions like the West Coast of the United States, anywhere where many of these services are actually commercial. So European countries subsidize their SMEs to the tune of $150 billion a year. There is an accepted public investment case in SMEs because of these public goods around job creation and so on. Learning, it's been touched on, I don't need to preach to the converted, but the most effective interventions monitored whether enterprises are actually growing and adapted accordingly. There was an RCT of a social enterprise program in France that found absolutely no results from the first time. They realized they'd been teaching entrepreneurs how to be an entrepreneur rather than taking a more problem-based pedagogy. When they made that change a year later, the results were much, much better. And finally, leading by example. So many interventions, we assume, again, that there's a market here of interventions. But actually, like the microfinance industry, it needs to be built. These institutions, these effective programs need to be built and developed, and they need to be invested in. The most effective interventions pay attention to developing themselves as organizations, and their partners and funders pay attention to this too. So having an effectively governed institution that's providing SME development services with empowered and capable staff, a good strategy, and diversified funding sources, because no one public funder typically can maintain something, although I think we've got an exception here. So we work in development, we've given an acronym SCALE. We've used it in our portfolio for the last 4 or 5 years, and we've seen that often very simple changes have dramatic results. We've seen one organization we work with that matches coaches to enterprises. They had really kind of the cost of it, the growth of the businesses they supported was about equal to the cost in the first cohort. The latest cohort they've run, the growth of the businesses is 50 times the cost of the intervention. And that's just because they introduced a charge and they balanced out the timing and intensity of their support to better enable learning. These are simple changes. They actually decrease the cost of the intervention. And so you don't, in a limited sort of policy, where you've got limited policy maneuverability in terms of the resources you can put in this, you can have massive gains from being more effective in how you're doing what you are doing. We've packaged up this, so much of the evidence here was summarized in some work with the IGC a few years ago. There's been some great new additions to the literature, but we see that these characteristics, this pattern is increasingly reinforced the more that evidence is generated.
If you can wrap up.
Sure. And it's in French, Spanish, Portuguese, and English, and there's a report and toolkit for policymakers, for practitioners to use that's freely accessible online. My highlights from this program is, great progress on long-term data. We're getting more insights on what works for who, which is really important, digging into this heterogeneity. I like the childcare for single women and entrepreneurs as an example. This returns to being an entrepreneurial state, South Korea being a golden example, but there are other good examples of sustained and focused investment into the SME sector can have incredibly high returns. And going forward, more of that, please, and especially on long-term data, focusing on employment. This is the #1 problem, and it will be for 10 years at least. And I know that it's difficult to get there, but the more that programs can look at that, the better, because this last point down here is really important. We see a lot of money being spent in this space. We see a lot of it still being spent on ineffective interventions, and the returns that we can get from just reallocating that money to more effective interventions or changing how it's allocated can be huge. And to enable that journey from all this knowledge that you've created to policy and practice means more engagement with those policymakers and making sure that when you're writing up and even designing research, you're speaking to some of the priorities that they have. And thank you very much.
Thank you very much. Taufik, if you can take the floor for 10 minutes max.
Merci, ça va être plus simple, il n'y aura pas de diapo. Je vais de mon côté vous raconter un petit peu le terrain de notre établissement, Tsemilcom. C'est ex-caisse centrale de garantie, c'est la plus vieille institution de garantie dans la région MENA. Nous existons depuis 1949 et sur toute cette période, nous avions eu des cycles de vie assez particuliers et particuliers dans la mesure où on s'est adapté aux besoins de chaque époque. 49, même après post-indépendance, les besoins du pays sont énormes et nous avons été l'outil financier de l'État pour mobiliser l'épargne internationale pour financement des gros projets d'infrastructure, l'énergie, les mines, le transport aérien, terrestre, ferroviaire et ainsi de suite. Suivi un cycle dans lequel on était pratiquement à l'origine de création de tout un secteur d'activité économique qui était la pêche hauturière, secteur dans lequel nous avions une exposition assez forte et dans laquelle nous avons quand même été un élément, une partie prenante pour faire émerger un secteur qui n'existait de nulle part, vraiment création ex nihilo. Cette partie de notre histoire nous a marqué au fer rouge pratiquement parce que nous avions des expositions assez fortes sur de la corporate, pratiquement, de grosses PME à taille européenne. Et évoluant et chemin faisant, on a tourné notre vue de la grande entreprise vers la PME. Et nous avons revu notre existence, notre business model, pour nous adapter à ce marché-là, qu'on avait connu auparavant, mais pas de manière assez profonde, pas de manière assez professionnelle. Pour l'attaquer, il faut connaître également l'état de l'économie marocaine pendant cette période. Ce qui a fait que, dans notre histoire, on a appris, comme a dit l'intervenant juste avant moi, il ne faut pas seulement savoir faire, mais comment le faire. Et quand on a voulu s'adresser à la PME, on l'a vu en un marché encore plus risqué que dans lequel on a été. Par conséquent, nous avons trop fermé les mailles du filet pour attaquer cette population-là, en termes de garantie principalement. Donc, ça n'a pas trop bien pris, parce qu'il y a une misunderstanding entre nous et les banquiers, qui, eux, distribuaient le crédit. Et à un moment donné, on a dit, on arrête cette chanson, ça n'avance pas beaucoup, et on va se mettre devant nos banquiers, nos partenaires, sur une feuille blanche. Et on leur a dit la question suivante, comment vous travaillez, comment vous adressez la PME? Nous, on est là pour partager le risque. Et ensemble, de cette feuille blanche, nous avons construit un modèle depuis 2009. Aujourd'hui, vraiment, sans trop de modestie, c'est la success story sur la région MENA en termes d'institutions, grâce à l'additionnalité, je vais peut-être en parler tout à l'heure. Mais avant d'en parler sur l'additionnalité et l'impact que nous avons, notre raison d'être, comme je l'ai dit tout au début, c'est les failles du marché. Nous sommes un instrument de la politique économique de l'État, nous sommes un bras financier de l'État pour adresser des failles du marché, du financement, de la TPE, la PME. Et comme vous le savez, dernier rapport de l'Observatoire de la TPME marocain publié, plus de 95% des entreprises marocaines sont des TPE et des micro-entreprises. La PME à elle seule n'est à peine de 4%, moins de 4%. Donc quand vous vous adressez à ce type de population, il faut voir qui sert ces populations-là. Parce que notre business model, c'est un business de B2B. Donc nous n'avons pas de relation directe avec les PME, l'entreprise de manière générale. Nous avons un contact avec la banque. La banque, c'est notre client. Et nous ne nous interférons pas dans la relation directe. Les critères d'éligibilité, nous les avons voulus très simples. Tous les secteurs sont compris, quelle que soit l'activité, quel que soit le statut juridique. Nous excluons uniquement deux secteurs, la promotion immobilière et la pêche hauturière. Tout le reste est compris. Et nous stratifiant le marché par taille, TPE et PME. Le critère que nous retenons, c'est un critère très simple, c'est le montant de l'exposition. Parce qu'adresser des entreprises par chiffre d'affaires, vous connaissez un petit peu la problématique de la data au Maroc, des entreprises qui overlappent d'une année à l'autre. Donc moins d'1 million de dirhams, pour nous, c'est la TPE. Au-delà, c'est de la PME jusqu'à une exposition de 10 millions de dirhams. Et comment on le fait? Alors, on garantit tous les besoins de financement d'entreprise. Ça, c'est des besoins de crédits d'investissement amortissables, des crédits de fonctionnement, des crédits de restructuration, tous les besoins qui sont servis par les banques, nous les couvrons dans notre garantie. Cette garantie, elle se veut comme partage de risque. Nous ne prenons pas la totalité, mais nous partageons ce risque. Ça va de 50 à 80%. Et ce paramétrage, il est assez intéressant pour les banques dans la mesure où nous stratifions les engagements par profil de risque. Et là où le risque est fort, nous proposons une garantie la plus forte. Exemple, le profil de risque le plus exposé chez nous, c'est la création d'entreprises, contrairement versus à des projets de développement d'entreprise qui a plus de 3 ans d'activité. Alors pour tout ce qui est création d'entreprise, nous garantissons 70% du crédit. Quand c'est du développement, on fait moins, on fait 60%. Pour vous dire, nous avons un message assez atypique par rapport à un comportement de banquier qui lui raisonnerait plus le risque est fort, plus je serai exigeant en termes de collatéral. Et le collatéral, c'est le rôle que nous jouons vis-à-vis des banques. Alors, en termes d'impact, rien que sur les 6 dernières années, on est passé sur l'ensemble des crédits aux sociétés non financières, la part des TPME est partie de 34% à 43%. Grâce en partie à cette stratégie publique, un de ces éléments de stratégie de l'inclusion financière et un de ces éléments de cette inclusion est notre institution et par conséquent la garantie. Un autre élément d'impact, nous faisons un cycle régulier tous les 4-5 ans, une évaluation d'impact pour savoir ce que nous coûtons et ce que nous rapportons pour la puissance publique parce que nous travaillons avec des deniers publics dans la mesure où le fait de partager le risque avec la banque, cela voudrait dire que quelque part, quelqu'un qui paye. Et c'est nous qui prenons cette partie. Les commissions de garantie chez nous, elles sont entre 0,5 à 1,5, mais ce n'est pas le véritable coût de cette garantie. Elle serait plus. Et ce différentiel entre le réel et cette commission, c'est adressé par des dotations de garantie que nous recevons annuellement pour faire face à chaque cohorte d'engagement. Alors, nous avons sur l'ensemble de notre portefeuille, l'étude d'impact, elle a reconfirmé encore en 2021, 80% d'additionnalité. Autrement dit, sur nos portefeuilles, 8 entreprises sur 10 n'auraient jamais eu accès au crédit s'il n'y avait pas la garantie de Temwilcom. Le deuxième élément d'impact qui mesure un petit peu coût-bénéfice pour la puissance publique, c'est sur chaque dirham de garantie sur un cycle économique, il rapporte pour le Trésor 3,1%. Pour vous dire l'additionnalité, l'impact financier. Il ne rapporte pas directement, mais il rapporte par l'ensemble des flux de transferts, notamment fiscaux, qu'engrange le Trésor grâce à cette création de valeur et de jobs effectués par ces entreprises qui ont accès au crédit, sans cette garantie, ils n'auraient pas pu réaliser leur projet. Alors, comme je l'ai dit tout à l'heure, nous sommes un instrument qui adresse les failles du marché. Alors, le Maroc est un pays dont l'économie est une économie de dette, principalement. Mais ceci ne nous a pas laissé les bras croisés pour aller ouvrir d'autres sources de financement à l'entreprise. Et je terminais par ce dernier point, c'est l'equity. Il y avait une intervention tout à l'heure sur la micro-equity. Alors, on s'est intéressé à ce marché et plus particulièrement à celui de la start-up innovante. Ce que nous avons remarqué déjà quand on a fait notre roadshow, c'est que le capital investissement au Maroc s'intéresse à des gros tickets, à partir de 3, 4, 5 millions d'euros. Quand on les challenge sur des petits tickets pour la PME et la TPE, ce n'est pas intéressant pour eux, pour différentes raisons. Et principalement, parmi les principales raisons, c'est les coûts des transactions sont tellement énormes qu'ils n'arrivent pas à réduire et à amortir, plus le risque sur la start-up et l'entreprise. Nous avons vu une petite expérience en 2012, où nous avons fait des fonds pour la PME, c'est la première fois, nous avons structuré de fonds, aujourd'hui ils sont en fin de période de désinvestissement. Ça a permis un petit peu de déplacer le curseur, et nous avons voulu encore le déplacer davantage en s'adressant à l'amorçage. Ce n'était pas simple. Ce n'était pas simple dans la mesure où on avait du mal à... D'abord, l'écosystème dans sa globalité n'était pas assez bien structuré. Il manquait le maillon écosystème de l'amorçage, qui existait, en tout cas, il existait embryonnaire, balbutinant. Il fallait créer un petit peu de la force, de la dynamique. Et il y avait l'aspect equity, où il fallait créer des fonds d'amorçage plus particulièrement adressant la start-up innovante. Alors, ce que nous avons fait, c'est que sur la première composante, toujours fidèle à notre stratégie, c'est le B2B. On ne remplace jamais les acteurs du marché. Nous n'avons pas la prétention de pouvoir tout faire et bien faire. Donc on s'appuie sur les acteurs du marché. Donc nous avons labellisé 16 structures, des incubateurs, des accélérateurs, et on leur a mis à disposition des outils de financement spécifiques et adaptés à cette population. On sait très bien, ce n'est pas avec de la dette bancaire qu'on va financer de l'innovation. Et donc nous avons mis du grant, des subventions, et nous avons fait également des smart loans, des prêts qui sont sans intérêt, sans garantie, remboursables en cas de réussite. Ça nous a permis, grâce à cette activité-là, au bout de 3 ans, nous venons de faire une évaluation à mi-parcours, plus de 460 startups innovantes ont vu le jour. Et ce qui est un petit peu très remarquable, c'est que 81% d'entre elles sont encore en vie, malgré la crise Covid qui était passée par là, grâce à un soutien également de certains DFIs qui nous ont accompagnés pour apporter de l'aide et surtout de l'appui financier. Alors, cette structure, donc ce maillon en amont de tout ce qui était appui, services non financiers par les incubateurs et les accélérateurs, devait trouver, à un moment donné, se trouver dans une situation où ils avaient besoin de lever des fonds. Alors, il fallait des fonds d'amorçage. Nous en avons structuré 3. Et notre objectif, c'était de comment faire ramener des investisseurs privés avec nous sur cette aventure. Et on peut dire que nous avons réussi parce qu'on tablait à lever, on avait mis 300 millions de dirhams sur la table, on a levé plus de 2 fois de ce que nous attendions. Pratiquement par l'attrait du marché, plateforme Maroc, et également par des incentives que nous avions mis à disposition de ces investisseurs privés qui nous ont rejoints dans ce fonds. D'abord en termes de garantie de leur mise, on fait une garantie de 60% de chaque ticket. La part de l'investisseur privé dans la start-up est garantie à hauteur de 60%. Deuxième incentive, c'est que nous prenons en charge une partie de l'assistance technique. On l'a su, en matière d'innovation, il y a des secteurs, surtout en termes de deep tech, il y a des expertises qui ne peuvent pas être financées par les management fees que prennent les sociétés de gestion. Donc il faut rapporter un appui financier pour que le business se fasse dans des meilleures conditions. Donc nous apportons de l'assistance technique qui permet un petit peu de bonifier, préparer le ticket au comité d'investissement. Et le troisième levier, le dernier, c'est que nous avons décidé d'une asymétrie du rendement. Autrement dit, sur un objectif de TRI de 8%, on a dit aux investisseurs privés qui nous ont rejoints dans cette aventure, dans cette expérience, au cas où le TRI au final serait moins de 8, nous, Tsemwilcom, parti public, on abandonne notre quote-part pour bonifier celle du secteur privé pour qu'il puisse arriver à ces 8%. Nous avons des belles pépites, peut-être vous en avez entendu parler de quelques-unes d'entre elles, So8 dans l'agritech, il y en a dans la deep tech, dans surtout reconnaissance faciale, vraiment des belles expériences. Alors, où on en est? On est aujourd'hui dans cette évaluation, nous sommes en train d'élaborer notre prochain plan de développement et nous sommes en train de faire, en tout cas de négocier un nouveau virage dans la mesure où on n'est plus dans l'accès au marché TPME, PME. On est en train un peu plus de finesse dans l'analyse des besoins où nous identifions quelques pavés de problématiques. On a identifié 6. Ces problématiques que nous souhaiterions adresser par ces outils-là. Garantie, equity, cofinancement également, et des services non financiers que nous sommes en train de développer. On a identifié le premier qui nous vient de manière naturelle, c'est l'inclusion financière. Et l'inclusion financière, je vous dis tout à l'heure, la PME, c'est moins de 4%, c'est la TPE et la micro-entreprise. Et ça, ce ne sont pas les banquiers qui adressent cette population, c'est les associations de microfinance. Et les associations de microfinance ont une connaissance assez approfondie et une proximité avec leur clientèle qui peuvent être un levier pour massifier davantage et surtout capter une bonne partie de l'informel vers le formel. Nous agissons avec les AMC à 2 niveaux. D'abord dans la garantie des micro-entreprises TPME qu'elles financent, et aussi dans la mobilisation des ressources de financement de ces AMC en elles-mêmes. Vous savez, vient d'être récemment par la loi bancaire comme établissement du crédit, sont sous la supervision bancaire, et donc ça nous rassure dans d'autres besoins, tout ce qui est le green, la transition énergétique numérique. Je parle d'internationalisation des entreprises, de l'investissement, d'innovation.
Est-ce que c'est possible de résumer un petit peu rapidement? Parce qu'on arrive au terme des 10 minutes.
C'est fini. Merci. Merci à vous.
Alors, merci beaucoup. Donc, on va prendre quelques questions auxquelles on va laisser les intervenants répondre. Ah, il faut que je parle anglais maintenant. Ouais. OK. So I need to switch to English. My brain is starting to fog. Thank you very much for this for very complimentary intervention. So I have personally only one question, which I think it's kind of at the heart of what was discussed in these 2 days. I mean, we clearly have now a lot of very, very good results from either RCTs or structural approach, and beyond that, people are starting to ask the issue of scalability. So how we kind of really now deal with this scalability and transform it in public policy that governments are willing to invest in and develop. So I think that's my question now. What will be the key players that will help all these important results to convert into financeable public policy? So that's my question. Other questions? Okay, Yannick here.
Thanks to all the panelists for all the very, very nice and inspiring presentations. I have a kind of a naive and voluntarily provocative question, which is we've been talking about small and medium-sized enterprises, firms, since yesterday, and you may wonder, why should we really focus on small enterprises, small companies, instead of just helping the larger ones become even larger? And yesterday there was a very intriguing talk about those small manufacturing firms which were producing highly customized products, and it was very difficult for them to achieve a strong division of labor inside the firm compared to other firms producing more standardized product where the division of labor was kind of more natural. So the question in a way is, shouldn't we try to get rid of all those small firms producing highly customized products and welcome large firms making standardized products where you have a lot of division of labor learning, increasing returns, and and isn't that in some way what we call industrial development? So that's voluntarily provocative, but I'd be interested to have your insights on that.
Thank you, Yannick. Other questions? So this is one here, maybe on the second row, and then the first row. Yes.
Thank you very much. It will be very brief. It's about what was said today about informal sector. I just want to insist that there is huge difference between informal sector and non-observed economy. This last one includes the informal sector. So when we evaluate it, we need to be careful about what we are talking about. On the other hand, there is a huge difference and heterogeneity in the informal unit production. So there is different segment, and when we address them, we need to take into account this heterogeneity. That's it. Thank you.
Thank you very much. A question in the front.
I have one comment and one question. My comment is on women participation, and you try to explain it with social norms. Maybe in some reports they try to explain it with social norms. Do you think that it is more related to the opportunities that the economy, Moroccan economy or MENA region in general, create are very weak? And maybe this is the main reason that make this women participation to job market very, very, very weak. This is my comment, and my question to Revoltella. You tell us that among the constraints facing the private sector is the informal sector. How to deal with the informal sector from a point of view, how we can reduce this informal sector? Thank you.
Good morning for everyone. The question is related to the participation, related to the question asked by Mr. Saidi. Does participation into the labor market has nefast and external negative effect on the marriage institution, for instance? Because as Michel Sandel, one of the leading philosophers in America today, has stated in clear terms that we have moved from an economic system to a society, or let's say a market society. Not only that will limit any calculus utilitarian reasoning to economic specific markets, but we have moved because, as you know, participation to the labor market has some sociological, let's say, institutional effect. Could you please elaborate why we focus a lot of our attention to economic outcomes? Thank you indeed.
Thank you very much. So I suggest that each panelist take 2 minutes to answer those questions, or the question he wants to answer. You don't have to answer them all. Maybe we can start with Sarah.
Thank you very much. I'm just going to rebound on 2 questions. The first one concerning big firms and jobs, and I'm going to speak in the context of Morocco. That was the development model followed by the Moroccan authority. It didn't work. It didn't trickle down to the rest of the economy. It didn't generate local PME, medium enterprises to become bigger. So your question, maybe it's a model, but all we've been talking about for the last 2 days, it's because it doesn't work. If it were to work, we wouldn't be discussing what we've been discussing. Even to tell you, in the automotive sector, you only have 2 Moroccan companies that were able to hook themselves to the automotive sector. One is Toyota, which produce cables that weren't used in the context of the automotive industry, but were able to do it. And the other one is Dolly Doll, which everybody knows here, who fabric mattresses, and were able to switch. That's the two examples we know of. So if that model were working, I don't think we will have that conference. That's the first point. The second point is I refer to the future of jobs. We know that jobs are changing. So, I don't think that big company as we know it will resolve the problem on the labor market. Because you won't have wage permanent jobs anymore. So that's why I was talking about a cluster of productive activities and not big firms. So if we have a solution for big firms to work, or the ones that are here to trickle to the rest of the economy, that will be the solution. But being a pragmatist, it hasn't happened so far. The second comment I would like to make is on women participation. I think we were on the same line, and I must not have been clear, which is very often my case. When I talk about social norm, is the de facto argument which is raised to explain the lack of participation of women in the labor force. Social norm says nothing to me. I don't know what it is. I don't know what a social norm is. So I think it's not a potent explanation and it doesn't lead to fact-based policy advice. That's why I was proposing to you guys as researchers to define what is a social norm, what are its components, and test for that. Is it transport? Is it childcare? Is it participation to the husband, to the housework we saw in the case of Uganda? That's not where the main constraint was. I don't know. That was my question. So I think we are on the same line. That's the two questions I'm going to answer to.
Okay, sorry. On my side, I also will answer a couple of questions. I guess the one on the informal sector were on my presentation, both of them. What we do in the report, actually, the report is only, the survey per se, the enterprise survey is only addressed to firms in the formal sector. But what we have is a question to the firms whether they consider they are affected by competition from the informal sector. So it's a very indirect way, but it's the perception of the formal firms on being affected by the informal sector. And what we have actually, and I invite you to look at the paper because I'm really not making justice to the paper, but what we have in the paper is that actually the firms that feel to be affected, they have a much lower employment growth, much lower skilled workers, much higher temporary workers, and you have all the controlling factor on sectors in which they operate, etc. So that's kind of, and also they have a much worse access to finance. So it seems to be really that it's affecting. So the firms affected are really affected. There is an impact on that. What to do about it? It's a difficult, it's a very difficult answer. I think it's re-looking very much at the regulatory effect and what's the constraint that prevent firms to re-enter into the formality, etc. But it's a never-ending area of studies on what to do to reduce the informality. So I don't want to say too much. The second point I wanted to mention, actually on 2 points. One on scalability, what could be done, and for scalability of the instruments in place. It's difficult to answer, but and here I mix a bit of our experience as an institution in Europe, as of in the MENA region, in other countries of operations. And I think we also test various instruments, particularly on access to finance. We also lend to banks to lend of SME. We provide guarantees. We are active in all the private equity, venture capital market, again, in Europe and out of Europe. Part of the story that we have is that it's not always only finance that matters. So there is a lot, and we have seen in many papers, there is a lot of skills missing on the bank side, on how to deal, on the financing side, on how to deal with the complexity of SME, on innovation firms, etc. So the technical assistance is very important, and part is skills missing on the company side. And again, technical assistance is important. In terms of scalability, what we tried to do, and it's just a couple of examples, we started some online training courses on access to finance, one that is jointly done, EIB and IMF, on access to finance, that normally the IMF would do this course only targeting a public sector employees. We actually remodified it also to make it available also to bankers in the region and try to think at access to finance issues. It was a super success. The IMF was very surprised that there was so much take-up also from the private sector. And I think that somehow maybe we can use much more this new online training also for much more diffusion of instrument courses and training methods that we already had. So that's one idea.
Thank you very much. Yeah, you want to...
Thank you. Deux interrogations, deux questions auxquelles je voudrais un petit peu partager, non pas répondre. Je n'ai pas la prétention d'avoir la connaissance, et encore moins académique, pour ces sujets-là. Le premier est celui de pourquoi ne pas adresser que les grandes entreprises, la corporate, et au détriment de la TPE, PME. En fait, il y a un fait... Regardez toutes les statistiques, notamment pas ici, mais en Europe, même l'Afrique du Nord et les États-Unis, Amérique du Nord. La statistique vous dit que plus de 90% des entreprises sont de taille-là. Et ce n'est pas un phénomène passager, c'est structurel. Et on aurait aimé, on n'est pas dans l'économie du 16e, 17e siècle, l'industrie naissante, on ne se soucie pas. Aujourd'hui, c'est beaucoup plus de l'économie sociale, j'ajouterais même pour certaines considérations solidaires, qui se met en route, qui se développe et qu'il faut accompagner parce que c'est quand même c'est une cohésion, et ça accompagne un petit peu le développement de notre environnement d'une manière générale. Et les territoires que nous avons, nous constatons un développement du périurbain d'une manière trop forte, et tous les besoins, notamment en termes de services à la personne qui se développent. Ça, c'est un point. En tout cas, nous, on est concernés, on est poussés. Et ce qu'on appelle chez nous, il y a toute une stratégie nationale d'inclusion financière, et nous constatons que et je transite sur la deuxième question, par l'inclusion financière, il y a une forte corrélation, je ne m'hasarderai pas à dire quelle intensité, entre l'inclusion financière et l'amélioration des revenus et du standing de vie des gens, et plus particulièrement celle des femmes. L'accès au crédit, l'inclusion financière, aussi bien dette, assurance, logement, améliore fortement le niveau de vie des gens, et aussi permet de contribuer à la création d'emplois. Et ça a aussi, je terminerai par ce point-là, ça a aussi cet attribut, cette caractéristique qui sont tellement dynamiques et qu'elles peuvent accompagner les cycles économiques de chaque pays. Il y a une telle adaptation, une telle capacité de pouvoir renaître, naître et de se transformer en adressant des besoins nouveaux. Bon, à charge pour nous de les identifier, les anticiper et proposer l'offre qui leur convient. Voilà.
So, I think the only thing I've got to add to the fellow panelists is on scaling. I think that, firstly, you can scale the depth of the outcomes by focusing on those enterprises that can generate the most outcomes with the resources you're putting in. So, you know, yes, informal sector is important. How do you put in a good floor? But they're not going to transform your economy, so it's only ever going to be remedial. You need to go for the growth-orientated firms to get scaled outcomes. You need to build institutions that can work into that space, whether they're financial or non-financial. And you need to promote connectivity. So it's a lovely paper of why Silicon Valley and not in Texas, given that Texas had a 5-year head start with Texas Instruments. And basically it's because Texas Instruments gobbled up or gobbled up any of the firms that were coming to compete, whereas in Silicon Valley, as employees left some of the first movers, they were invested in or mentored by those successful firms, the successful entrepreneurs who had been through that journey. And you can see that about 90% of the industry as of the about 90% of the industry is in some way connected to that first firm. And you see this in entrepreneurial ecosystems around the world that have developed successful clusters, is you can start getting a self-propelling nature when you start getting some success stories. And when you motivate those entrepreneurs to reinvest in their community. So those are the few pieces, and we've got more results. We've got some RCTs comparing digital training to in-person. The findings are, we're not there yet, but on a number of the evaluations, just a word of caution on digital training is that people can assume that our digital selves are the same as our in-person selves, when in fact we might want to self-pace things differently. And so it can lead us to design training programs suboptimally, and the costs are often higher because they're not higher than in person, but they're higher than we assume they are, because you need to stimulate the engagement that is easier, that comes naturally in person. So yes, digital, how and where can digital delivery be really effective for scaling, but don't let that detract from connectivity and focusing on scaling outcomes.
Thank you very much, and thank you for all the panelists. And I think it's time to conclude. You want to say a word, Kenza, maybe?
Very quickly, I think we should all thank the speakers, so presenters, discussants, and panelists for really inspiring presentations. I personally had a great time, really enjoyed the conference. So thank you, thanks to everybody. Yeah. And a special thanks also to Abdesamad Sidi from the Bank Al-Maghrib and his team for a flawless organization. Last announcement, so as you notice, we are running quite late with the schedule. So we decided that we will start the tour of Rabat half an hour earlier, so from 3:30, but we will go directly from the conference venue. So we have about 1 hour for lunch, and then we can go for the tour, if it's okay with you. Thank you.